Open, everyone. A minute to go to the start of cash equity trading. I'm Francine Lacroix here in London, and here are your top stories. The rout in Adani shares hit $71 billion, and the company's bonds slide. That's as Hindenburg says the group's 413-page response to its allegations fails to answer most questions. Well, stocks and futures fall as investors weigh Adani's plunge, China's reopening, and a mega week for central bank rate decisions. Plus, the French automaker Renault agrees to cut its stake in Nissan to 15% as part of a major revamp of the two-decade-old alliance. So let's take a look at the futures. A happy Monday, everyone. I'm glad everyone's made it through the weekend. It's going to be a big, big week for central banks, and futures actually on the downside. Now, as we're expecting, of course, the markets to open, European stock futures down some 0.5%. Again, if you look at the shares declining overall, also in Asia. Traders and investors really splitting their attention, first of all, on the looming interest rate decisions in the U.S. and Europe, but also the reopening of mainland China and what's going on in the plunge with Adani Group assets. So this is a picture across the board for what's going on. So we're not only expecting a lot of the indices to stay a little bit subdued as we expect more news from central banks, but the broader outlook for the Fed is keeping downward pressure on the dollar, which has helped Asian markets outperform the U.S. this year. So that's a picture across the board. We also always keep an eye on commodities. I'm looking at gold down 0.2%. And as expected, a lot of these equity markets are opening on the downside. I'm seeing a little bit of green actually for the CAC 40. Now, Fed officials, this is what we're looking at in general. Central bank and Fed officials look set to downshift the pace of rate hikes on Wednesday. For the markets, it's all about Jay Powell's outlook on the U.S. economy. Of course, Bloomberg's markets reporter Valerie Teitel has been all over this. So, Valerie, good morning. What data could Powell use to sound hawkish or sound dovish?
Yeah, Francine, it's really about all his outlook on the U.S. economy. I think if you wanted to sound dovish, he could acknowledge the recent deterioration in the survey data. Now, these are the soft sentiment indicators, but they're clearly have all been heading in the same direction. You can compare the magnitude of the move to the deterioration we saw in 2008, and it has been notable. He could really lean into this and say, look, the deterioration in this data is enough. It's enough to stop talking about ongoing rate rises, and enough for me to start talking about a pause, about a possible pivot. But if he wanted to sound hawkish, Francine, he could really lay into the U.S. labor market data and essentially say, this labor market is way too hot. We know that wage inflation is something that's going to keep core services CPI quite buoyed, and he can lean into that Phillips curve narrative saying, I need to see some deterioration in this hard labor market data in order for me to start talking about a pause, talking about a pivot. But thirdly, Francine, he could sound quite boring. He could really try not to come off as hawkish or dovish because he knows there is a huge amount of data in between this meeting and March. And don't forget, in March, we also get their updated dot plot and their updated forecasts. Perhaps if he wanted to make waves, he'll wait till then and make it sound for itself if they, for instance, revise down their inflation forecast and revise down their dot plot and make their dovish pivot then.
Yeah, maybe there's a bit of defiance from the Fed and he walks the tightrope. Our Bloomberg market reporter, Valerie Teitel, they're looking ahead to what Jay Powell could say. We also heard from Morgan Stanley saying, look, it's just not the right time to chase the rally as the Fed is looming. Now, markets in mainland China have reopened after the week-long Lunar New Year holiday, with the benchmark equity gauge set to enter a bull market. For more, let's bring in Bloomberg's chief China markets reporter, Sofia Ortega-Costa. Sofia, good morning to you. So what's the takeaway from what China will do from here on end?
So it was quite a muted reopen, Francine, considering the gains that we saw in offshore markets in Hong Kong. So the CSI only rose about 0.4%, really a catch-up rally in the yuan as well. But the fact that it was a muted reopening, given the data that we saw in consumption spending, in travel, really markets are taking profits there, and stocks in Hong Kong fell quite significantly. So the story is really take profit when the good news does come, but also get ahead of the good news. We saw some strong northbound buying that suggests that foreign investors do want to get in into the onshore markets in China, but really caution prevailing in the Asian session, and the fact that onshore stocks did not enter a bull market today suggests a little bit more upside, but we'll see what the trend is this week.
Sophia, when you look at some of, I guess, what policymakers in China are telling us, what does that mean for equities going forward?
So it's all about liquidity. Liquidity will remain appropriate. That's a key word. So not ample. This is the key thing for the PBOC, the central bank in Beijing, that it will ensure that there's enough money in the banking system to really get the credit growth story picking up. That was really the main challenge that in the final quarter of last year, and the reason why businesses weren't borrowing. There was just no demand. I mean, when you have the economy shut because of COVID-0, it makes no sense to borrow. So really looking ahead at that, looking ahead at what policymakers do to support the housing market. In the lead up to the Lunar New Year, obviously we had really a ramp up in support measures. So more to look for there. And also any conversations around what it will take to really boost consumption, because the Lunar New Year is a strong season for that. But whether it will continue and whether it will stick, whether this is a trend and the consumer is getting more confident, that's the key question for policymakers ahead, Francine.
Thank you so much. Our Bloomberg Chief China Markets Reporter, Sofia Horta Acosta. Now, we're also getting some breaking news out of Spain. Preliminary January harmonized CPI rising 5.8% year on year instead of the 4.8% that was expected. Now, the interesting bit about inflation in Spain is that a lot of the markets look at Spain as forward-looking indicators for the rest of the Eurozone, as inflation ticked up in Spain before it did in the rest of the region. Joining us now is Marcus Morris-Eiton. He is European Equity Portfolio Manager at Allianz Global Investors. So, Marcus, thank you for joining us. What does that inflation number tell us about what inflation could do next? We did have a bit of market movement, euro spiking on that as soon as it hit, and the German two-year yield also moving a little bit higher.
Yeah, good morning, Francine. I think what this really illustrates is that while central banks have had some breathing space because of the inflation data we've seen in recent weeks, we're certainly not through the woods. This is a very clear reminder from many investors who have actually expected inflation to be pulling back much sharper than it has done, really that we do need to be cognizant of this, because core inflation will remain robust, and particularly when you see some of the labour wage data that we're seeing across the board at the moment.
So what does that mean, Marcus, for your asset allocation? I don't know whether you look at earnings or whether you still try not to fight the Fed and look at central banks.
Yeah, we're at the beginning of an exciting week here because, as you said earlier, we've got a slew of macro data with the three major central banks reporting, and also a big week for earnings results across the board. And what we've seen so far is earnings generally being less bad than many people feared. I think most investors were expecting us to really be at the beginning of quite a profound earnings recession, and that's so far not materialised, which is why you've seen the relatively strong rally into the beginning of the year. What we are, though, recognising are really some recurrent themes from the earnings results that we've had so far. I think the first one to point out is that although headline revenue growth has been relatively robust, the majority of that has come from price rather than volume. So there are some worries there about how consumption might look moving forward. Secondly, I would mention that inventory levels across the board seem worryingly high, and that's certainly something for people to monitor moving forward. And really lastly is just the margin pressure that's beginning to materialise, partly as a consequence of these higher inflation and price pressures that we're indicating.
Yeah. But Marcus, so what does that mean? That it's time now to sell off, or what are the market exactly getting wrong? I know they're taking a lot of positive news that you think longer term could be actually quite negative. So do you sell off in sectors that have been seeing a rally in the last 2 months?
I think we've seen the most extreme moves already at the beginning of this year, and a lot of that was probably short covering. Because if you look at the areas of the market that have performed strongest year to date, it was really the areas that were in the eye of the storm last year. You've had technology and retail and also travel being the top three performing sectors. For the next step of the rally, I think we need more. And that will really be to prove not only that we're not having a profound earnings recession, but actually that companies can remain robust through this challenging period, which will inevitably happen in the next coming months. But the advantage for markets now is that valuations are much more reasonable. So I think I would urge investors to be selective, but generally I think we're relatively bullish with where we are currently.
What's your take on the semiconductor sector? So we have a good story, Marcus, which we'll get on in a second, in saying, look, there's just too many memory chips. I don't know whether that's an indicator of the industry or it's an indicator of more the worldwide economy and what we'll face in the next 12 months.
Yeah, I think it's exactly as you say, it's both. And the semiconductor industry is always an interesting one because typically they're highly cyclical. So you see the stocks, at least in terms of share prices, heading into the sell-off earlier than many other sectors, but also coming out of that quicker. And that's what we've seen so far. So there's no doubt earnings are weak, particularly on the memory side of the sector, and will likely remain weak. But actually the stocks in many of these places have traded pretty strongly. And that's a sign that actually investors are beginning to look through the recession already and play the upcoming recovery. And just to point out one result, a small Swiss company called VAT Group, they reported 43% year-on-year decline in orders 2 weeks ago, but actually the shares were up on the day. And that's probably a very clear indication that, as said, investors are well aware of the recession that's upcoming, but are running ahead of the market and looking to play that recovery.
Marcus, thanks so much. Marcus Morris-Ayton, European Equity Portfolio Manager at Allianz Global Investors, stays with us, and we'll talk a lot more about some of the industries that he likes. Now, this is other breaking news from Adani. Of course, this is the story that's really dominated all of the headlines in the last 3 days or so, 4 days. Adani Enterprises erases 10% of gains. All of 10 group stocks are actually dropping. So let's take a look at what exactly it's doing at the moment. Of course, the news over the weekend was that they responded and basically Heidenberg went back and saying, guys, this is not good enough. So billionaire Gautam Adani's 413-page attempt to restore confidence in his business empire does seem to be falling flat with his investors. The stock market losses deepening, and also some of the key dollar bonds falling to fresh lows. Coming up, Adani Group stocks and bonds continue to be under pressure as a lengthy rebuttal by the Indian conglomerate fails to ease concerns. The details just ahead. This is Bloomberg.
Coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. So
what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
News breaks. No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open, everyone. We are 13 minutes into the European trading day, and maybe worth spending just a bit of time on CPI in Spain. So first of all, we saw that inflation print January. It came out about 13 minutes ago, and it was higher than expected. Now, this is important. You think, Spain, okay, inflation, interesting, but only for Spain. Not so. It's been around 12 months or so that the markets are really looking at Spain as a forward-looking indicator for the rest of the Eurozone, because remember, inflation ticked up in Spain before it did anywhere else. So Spanish inflation unexpectedly jumping after months of easing, something that is getting a lot of investors on edge at the moment, and we're seeing a move in Bunds treasuries, gilts all a bit weaker after that Spanish CPI. Again, consumer prices in Spain advancing 5.8% from a year ago in January, up from a previous 5.5% increase. Now let's get more on Adani. Short seller Hindenburg Research says the group's response to its report alleging fraud and stock manipulation has failed to answer most of the questions it posed. The stocks and dollar bonds of many Adani Group companies have continued to drop after the lengthy rebuttal. Now, Adani says the report is bogus and unresearched. Now, let's get more with Bloomberg's conglomerates, PR Sanjay in Mumbai. Thank you for joining us. So what are the key features of the rebuttal from Adani?
So it's like a tale of rebuttals for Adani and Hindenburg. Yesterday night, late night, Adani has issued a 413-page rebuttal. Largely, in nutshell, what they are saying that these are baseless allegation, and Hindenburg Research is like largely ignorant about Indian laws, Indian regulators, and whatever this allegation is actually against not just Adani, but India also, India growth story. In other words, they are putting nationalism in front of this allegation to cover up. And also, Adani has clearly said it's deleveraging. It has been managed to raise equity funds from high-profile investors. And one last point, where allegation made on their directors, etc., that have been already been approved or okayed or given a green signal by Supreme Court. So essentially, Hindenburg Research did not understand Indian laws and regulatory regulatory framework of India. That's what Adani is saying, and Adani Group CFO has also given interviews to Indian television channels clarifying all this.
Yeah. So if you look at the rebuttal, it hasn't helped, stop the sell-off at all, Sanjay.
Which is true. The sell-off is actually continuing. Adani Group companies, the report to power conglomerate already lost $71 billion worth of market cap as of now. And most of the group companies are now back to red after erasing all the gains it had in the first session. So, and FPO will be ending tomorrow, and they have not opted for any repricing or extension of time period. So it is interesting to wait and watch how they will be managed to pull off this. India's so-called largest FPO in the making.
All right, thank you so much for joining us. Bloomberg's conglomerates reporter, PR Sanjay in Mumbai. Now let's get over to our Bloomberg Business Flash. Here's Adrian Wong in Hong Kong. Hi, Adrian.
Hi, Francine. Ryanair says it's confident that it can sustain its profitable run into next year and beyond as surging travel demand drives fares higher. Europe's largest discount airline reported profit after tax in the fiscal third quarter of 211 million euros, below estimates for 263 million euros. Ryanair says it's winning market share in places like Spain and Scandinavia and adding capacity in markets including the UK. Toyota has kept its crown as the world's top-selling car maker, widening its lead over Volkswagen. Despite supply chain disruptions continuing to weigh on the industry, Toyota Group sales were mostly flat at 10.5 million units for 2022. Volkswagen's output fell 7% last year to 8.3 million units, marking the lowest level of delivery in 11 years. And ASML says the chip export curbs on China shouldn't have a material effect on its earnings this year. The company is expecting sales of $6.6 to $7.1 billion this quarter. The US and its allies are restricting exports of some advanced chip-making machinery to China. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Adrian Wong in Hong Kong. Now, coming up, Renault and Nissan agree on a major revamp of their alliance. The details just ahead, and this is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open, everyone. 20 minutes into the European trading day. The picture across the board, a bit of pressure, not only because we're waiting, of course, for big central bank decisions this week, but that CPI print in Spain, possibly an indicator of what's to come in the rest of the Eurozone, because it was the first one to show those signs of uptick, actually unexpectedly jumping for the month of January. So markets on tenterhooks. Now, Renault has agreed to lower its stake in Nissan to 15%. The move equalizes their cross-shareholding partnership in a revamped alliance. Now, joining us from Paris is our Bloomberg French transport reporter, Albertina Torsoli. Albertina, great to have you on TV this morning. So after months of drama, is this really it? What are the next steps?
Certainly good news for Renault and Nissan, of course, today. Key step forward. The board of the alliance, operating board, met on Thursday and gave a nod. The top executives of the three companies, let's not forget Mitsubishi here, gave their nod to this overhaul of an alliance that had become very complicated in the past few years. And as you say, a lot of drama. The statement this morning is quite smooth in language, but let's not forget that this is the result of months of tense talks. And yes, good news, but it's not the final word yet. The boards of the respective companies have to approve the deal now. Shouldn't be very problematic for the Renault board, but you know, with Nissan, we've seen surprises in the past. The independent board directors have given their nod to the plan on January 7, but until the contracts are signed, you know, we'll have to wait for those details to come in a few days.
So, Albertina, what does this mean effectively?
Yes, this is a good question because, of course, you know, Renault and Nissan want to show this as a continuation of a pact that they had, this alliance created in 1999 when Renault saved Nissan, you know, but Louis Schweitzer, who was the chairman at the time, in a book he wrote, said that, you know, the alliance was probably flawed from the beginning. So a lot of tensions over the years and resentment, Nissan side. Nissan went on to become a bigger company than Renault, you know, and obviously the spectacular downfall of Carlos Ghosn in 2018. So what does this mean going forward? Essentially, all companies in the automotive industry are under pressure. You have very quick technology innovations coming up, you know, with a dizzying speed. Think about Tesla, the capacity Tesla had, a newcomer, to you know, become a giant in just a few years. You have software companies also starting to play in the automotive industry. So Renault essentially and Nissan need to move forward with electrification. Renault particularly feels they need to be much quicker to snap up opportunities, deepen ties with the likes of Geely, which is a Chinese company, or Qualcomm, and the current structure really didn't allow to proceed so quickly. So I think both companies will have more autonomy to deal with the massive challenges ahead.
Yeah. All right, thank you so much. As always, our Bloomberg French transport reporter, Albertina Torsoli. Now, turning to the energy sector, and Shell's new chief says the oil major will overhaul its business units to simplify the organization and boost performance. Let's bring Bloomberg's energy and commodities reporter, Will Kennedy. Will, good morning. So give us the latest. What's included in this overhaul?
Well, it's sort of internal housekeeping. They've reduced the size of the executive committee from 9 to 7, but more importantly, they have created 2 very big power bases within the company, merging upstream with the integrated gas business to give someone oversight over the whole of the upstream business, and secondly, downstream the traditional refining and fuels business with the renewables business. So those 2 directorates, parts of the business, become very large and powerful.
So, well, what does it mean overall for some of the rivals? I mean, is this a template that, are they behind the curve, or actually does it show what other oil majors could do in the future?
Well, I think the background to this, we've got the new CEO, Wael Sawan, who's come in at the start of the year, and the big issue for Shell investors is that they're behind Chevron and Exxon, the 3 biggest oil companies in the world. If you look at their total return since the start of 2021, Shell has returned at just over 70%, not bad, but Chevron has done 110%, and Exxon about 180%, and I think the overriding desire for investors, including the activist investor Third Point who came into Shell, will be to close that gap. Now, the big question is, what does this mean for its energy transition strategy? Will it continue to build new energy businesses at the same pace? Importantly, the other decision that he's taken is to put the business that supplies power and gas into homes in the Netherlands and the UK under strategic review. So the questions that people will be asking as we get to earnings later this week and a strategy day in the spring is, does this signal a broader change of approach away from investing in new businesses and towards increasing shareholder returns through investors and buybacks to better compete with Chevron and Exxon?
Well, thank you so much, Will Kennedy, there with the very latest on the oil majors. Coming up, amid speculation that the Bank of Japan will normalize policy, we'll look at the yen's rally. Other stocks move, of course. A lot of stocks are falling. They're not only looking, investors are not only looking at Adani Group, but they're also looking at inflation print from Spain. This is Bloomberg.
somebody says, I want to be, a person has an impact on society, what would you recommend that somebody do to train themselves and to work their way up to be somebody that's impactful on society?
Well, I think the first thing you've got to believe in something that you really care about. You know, I've been fortunate that over the course of my career, I've come up with things that have mattered to me, and I've pursued them. You know, the best advice I ever got was from Mike Bloomberg. And he said to me at one point, he said, show me somebody who's never lost, and I'll show you a loser. And I believe that if you believe in something, go after it, take risk. Obviously, they should be smart risks, but they should be around things that you really care about.
So you would see your legacy as being actually target ALS and helping to moderate the impact of ALS, if not curing it.
That's my final legacy. I'm proud of some of the other stuff that I've done as well. Transformation of New York after 9/11. I'm also incredibly proud of a lot of the companies we created at Sidewalk, but I feel like I've done a lot.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
Pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Well, the Fed decides, and we have many, many other central banks. So welcome back to the Open. 30 minutes into the European trading day, and here are your top stories. The rout in Adani shares hits $72 billion on the company's bonds slide. That's as Hindenburg says the group's 413-page response to its allegations just fails to answer most questions. Plus, the French automaker Renault agrees to cut its stake in Nissan to 15% as part of a major revamp of the two-decade-old alliance. Plus, Spanish inflation unexpectedly jumps, prompting traders to boost bets on how the ECB will raise interest rates. Now, overall, this is what the markets are seeing. So first of all, they're looking at Adani, a lot of market caution, because if you look at what central banks could or could not do in terms of interest rate hikes, it could put a lot more pressure on some of these equities. European stocks down some 0.7%. The FTSE also under pressure. The DAX down 0.6%. Again, I guess there's a lot of caution that is creeping up in the markets at the start of the week. Not only its interest rate decision, we have the Fed, we have the Bank of England, but also big name company earnings on both sides of the Atlantic, and we hear this day in, day out, that actually so far equities maybe have been too pessimistic, given what could come ahead in terms of earnings and some of the margin squeeze. This is some of the groups that we're looking at in general. Now, first of all, it is about inflation in Spain. Of course, the inflationary figure in Spain higher than expected. This could be a cautionary tale for the rest of the Eurozone. There it is. All groups out of the 20 that make up the stock 600 are down. Now, some of them are not moving much. I'm looking at food and beverage. Some of the products or consumer products pretty much flat, but technology under pressure, down 2%. Travel and leisure also under pressure, as is real estate. Now, let's focus on the yen amid renewed speculation that the Bank of Japan will normalize policy. Now, that's after a panel recommended the BOJ make changes for its long-term inflation target. We're now joined by DZ Bank Chief FX Strategist Sonia Martin. Sonia, thank you for joining us. When you look at yen and the prospects of actually the Bank of Japan changing some of their expectations, does that come before the Governor Kuroda steps down, or is it a story from April onwards?
Good morning. Yeah, I think it's probably going to be a story from April onwards. The BOJ made a surprising decision in December to widen the trading band on JGBs, and that was seen as a signal, and the market has kind of been feeding off that since. So we've seen the yen rally significantly on the back of that. But I think we have to understand that the move that the BOJ took in December was driven mainly by its desire to take some pressure out of the JGB market. The market, as we all know, is entirely dysfunctional at this point. They had this idea, I think, of releasing the pressure valve, leaving some steam out, and of course that's kind of backfired on them because they have been forced to be very active in the market since, because there's a lot of speculation, as you just said, that the BOJ will take additional steps. But I doubt it's going to happen very near term. So I think we're going to have to wait until Kuroda leaves for that change to happen. And even when it does happen, it's maybe not going to be the massive change that investors are currently speculating on. We are expecting the BOJ to actually hike rates this year, but that's going to come at the end of the year. And we are going to talk about a 10 basis point rate hike, which, let's face it, isn't very much.
But, Sonia, at the same time, there's so many recommendations. I mean, we heard from a panel of experts saying actually the Japanese government and central bank should really revise the joint policy statement and make, for example, inflation a longer-term goal. Yeah. Are we already pricing this in? So is there a danger that the markets already think this will happen, and so there's not much shock and awe come April?
Well, yeah, we have already seen the yen rally significantly on the back of this. So a lot of this has been priced in. I still think, though, that once the BOJ does take another step later this year, that will have another impact on the yen. So I don't think it's fully priced in. We're coming out of a very, very long period of ultra-expansionary policy. So any changes to that are going to have an impact on the market. But again, a lot of it has already been priced in. So, I mean, I'm not looking at dollar yen to trade, I don't know, let's say below 120 on the back of that.
Are you talking about a normalization of yield functions, or is this a complete rethink of monetary policy for Japan?
Well, that will partially depend, I think, a bit on the path of inflation going forward. Inflation in Japan has obviously been higher, and the BOJ has had this narrative that the inflation rate is high because of external factors. But of course, the longer the inflation rate is higher now, the more pressure there will be on the BOJ to make a move. Whether they will abandon YCC, we'll have to see. That will be a major step, of course. But, I think at the moment, we're probably looking at somewhat more cautious steps because they don't want to rattle the market too much.
Sonia, where do you see yen at the end of the year? Or I don't know whether I should ask you, before the end of the summer and then at the end of the year, because a lot could happen from now until then.
Well, we are looking for the low 120s, but obviously there is a risk of slight overshooting. But I think that's sort of the area we're looking for.
What does that, Sonia, when you look at, euro yen or dollar yen, what's the best pairing? And I don't know whether we're looking for more, given the uncertainty also surrounding the Fed and what Jay Powell will say, I don't know whether you're expecting dollar strength.
Well, we definitely have a slightly negative view on the dollar, not overly dramatic, but definitely, we're not looking for the dollar to have another substantial strong year like we saw last year. So it's probably best paired against the dollar rather than the euro. It's also, look at the ECB. I mean, we're still looking at 125 basis points in rate hikes from the ECB. So that will give the euro some support. So I think the yen versus the dollar is definitely a better bet.
Sonia, when you look at euro and when you look at what we heard from that inflation in Spain, the markets are really taking that inflation number from Spain as a leading indicator because last time it was the first one that went up. I mean, is this still the case, or are there more domestic factors in Spain which would make this case different?
Well, we have quite a few countries in Europe that have shown, slightly softer inflation readings in December and that are expected to increase again in January. That also applies to Germany, for example, and that is because some of the measures that were taken by governments to soften the blow of higher energy prices are running out. So that's going to lead to a pickup in inflation pretty much across the Eurozone in January, and that was to be expected. And I think the reading from this morning was, surprisingly high, but generally speaking, it was anticipated that inflation would pick up again. I think the problem is really that the market seems to have thought inflation was over. The better inflation readings in December really gave cause to a lot of optimism on that front, and that was clearly overdone, and I think the numbers from the rest of the Eurozone will confirm this.
What does that mean for ECB policy?
Well, I mean, Christine Lagarde was very clear in December. She said, there's going to be at least another 250 basis point rate hikes, and that's absolutely what we're looking for. So we're looking for 50 basis points this week, another 50 in March, and then another 50 in early May, 25, in early May. So we have another 125 basis points in the pipeline. That is pretty much what the market is pricing in, but there had been some recent speculation that the ECB might slow down earlier, and that's really been put to rest with this morning's CPI reading.
And so you believe that actually a recession in the U.S. can't really be avoided, but you say that in Europe it can be avoided. Does that inflation print change anything? Is there a danger that actually the ECB over-tightens to make sure that it kicks inflation out of the way?
No, I think that we're still looking for some soft growth in the Eurozone. We're no longer looking for 2 consecutive quarters of negative growth, which is why it's no longer officially a recession. But there's a slowdown, and that is partially driven, of course, by high inflation and the loss of purchasing power as a result of that. Today's inflation reading doesn't change that. I think the ECB, if we're looking at 125 from here onwards, the ECB is moving into restrictive territory, but it's not as restrictive as, for example, the Fed is. So I think that's something they can sustain, and that is very much in line with their inflation target.
Sonia, thank you so much. Sonia Martin, their DZ Bank Chief FX Strategist. Now, coming up, the German Chancellor, Olaf Scholz, visits South America this weekend. So let's find out what he wants from the trip. That's coming up next, and this is Bloomberg.
Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Welcome back to The Open, everyone. 41 minutes into the European trading day, and this is a picture across the board. A lot of pressure, actually. The DAX, the CAC, all down some 0.3 to 0.4%. The focus, of course, not only on some of the things that we're seeing, which is positioning ahead of the Fed, ahead of the ECB, ahead of the Bank of England, but also a little bit of pressure because of the Adani rout, hitting $72 billion as a fight with Hindenburg is intensifying. Now, let's also check in on some of the stocks that are on the move. Now, we had some great reporters today bringing us some of these top top stories. We had Albertina Torsoli from our Paris office looking at Renault. Renault shares slipping some 4.1% after its reset details with its alliance with Nissan. So this is a pretty historic rebalancing. It's agreed Renault to lower its stake in Nissan, seeking to address this long-standing source of friction in the two-decade-old alliance to better compete in an industry moving to electrification, but also automation. The other stock mover is, of course, Shell. Now, we had our Will Kennedy bringing us up to date with this story. This could have huge ramifications or certainly a huge impact on some of the rivals as well. So look out for all oil majors. Shell overhauling its business after a new chief executive has taken over. It will combine its integrated gas and upstream divisions, but also merge its downstream and renewable units. And finally, Unilever. Now, this is, of course, one of our biggest top stories. We have a chief executive that will leave very soon. Today, the story is that it's picked the Dutch dairy boss as the chief executive after the tank with an activist shareholder. So we do have a new chief executive. His name is Hein Schumacher. And on the back of that, the share price gaining some 0.7%. So a mild winter may have helped Europe dodge the worst scenario from the energy crisis. But here's why the continent's economic powerhouse may still bear scars.
Europe will probably survive the winter without blackouts, but higher energy prices may leave their mark, particularly in Germany. Most developed economies have become services-driven. They don't actually make anything anymore, but not so in Deutschland. It's called Europe's engine for a reason. 19% of the economy is industry and manufacturing. That compares to only 11% in the US, 9% in France and the UK. Making stuff is great, but it takes a lot of energy. Industry sucks up nearly 28% of Germany's total power consumption. It's less than 20% in France. Giants like VW, Siemens, Mercedes, they can weather big storms, but a large proportion of German production comes from the so-called Mittelstand. For these mom-and-pop manufacturers, when energy prices explode, the threat can be existential, particularly in glass, concrete, steel, bricks, and chemicals. Mittelstand companies may be small, but together they are big business. SMEs in Germany employ 55% of the working population, and the Mittelstand is responsible for about 37% of industrial jobs. The government is doing what it can, breaking all records this year by borrowing more than €500 billion, but that can't go on forever. So now, Europe's biggest exporter needs to rebuild an industrial model that relied on cheap Russian gas that flows no more. Oliver Crook, Bloomberg News, Berlin.
Well, Bloomberg's Oliver Crook in Berlin with a look at the energy costs involved in keeping Germany's industrial and manufacturing sectors. Now, sticking with Germany, and the Chancellor, Olaf Scholz, visits South America this weekend. He hopes the trip will help the country secure additional supplies of the lithium that car giants like Mercedes-Benz and Volkswagen need for their electric vehicle batteries. Well, Bloomberg's Chad Thomas joins us now from Berlin. Chad, what a treat. Good morning. So what's the main message from Scholz on this trip?
Well, Francine, Scholz feels like Germany had to learn its lesson with the heavy reliance on Russian gas, and we all saw how painful that process has been over the last year or so. And so what he's now focused on is where do they find rare earths? And so he did this trip to South America. He was in Argentina on Saturday, Chile yesterday, Brazil today, and he's really looking for deals to get lithium. Of course, the German automotive industry, Oliver was just talking about that in his piece a minute ago, is so key to the economy here. And lithium, as we all know, is a key component of batteries. And as the car makers make that shift to electrification, they're going to need that lithium. And so he's working to secure contracts for these German companies for lithium.
So, Chad, I was surprised that, first of all, that this doesn't go through, I guess, a European Union voice. So it's not the president of the Commission. So I don't know whether he feels, he can achieve more as Germany. And he does seem to also be trying to take on China directly.
Well, he is. And the message that he was basically sending over the weekend is much of this lithium currently that they're producing is going to China, where China then is actually processing it and then reselling it. And the argument that he's making to these countries is, work with us, we'll help you to set up the manufacturing in your own country, where people will get jobs in Chile, in Argentina, processing the lithium and then sending it on to Germany. So that is the argument that he's making. He also says the Germans know how to do this in a way that's more environmentally friendly. So that is really the sales pitch that he's making. And clearly, he decided he's not going to wait for EU to take action here, that he needs to step forward as the German chancellor and try and secure some of these deals.
Chad, as always, great to have you on TV, our Bloomberg Chad Thomas there. Now let's get straight to the Bloomberg First Word News with Adrian Wong in Hong Kong. Hi, Adrian.
Hi, Francine. Adani has published a 413-page rebuttal to a short seller's allegations of fraud and stock manipulation. The Indian conglomerate, in the midst of a $2.5 billion share sale, is seeking to stem a rout that's wiped out more than $60 billion of market value. Hindenburg Research, which published the initial report, says Adani's response has failed to answer 62 of 88 questions that it posed. Israel says it may penalize the families of Palestinian attackers by revoking identity cards and residency if they support violence. The warning comes after a Palestinian man shot and killed 7 civilians on Friday. That followed a deadly Israeli raid in the West Bank city of Jenin. The rising violence, I should say, making January one of the bloodiest months in years, comes ahead of a visit by U.S. Secretary of State Antony Blinken later this week. Bloomberg has learned that top investment bankers in Asia are seeing their pay packets cut in half this year. Sources tell us that on average, managing directors at banks including Goldman Sachs, Morgan Stanley, and Bank of America are seeing compensation drop by between 40 and 50%. The news comes as a slump in deal making pushes the industry to look for ways to keep a lid on spiraling costs. Global news 24 hours a day on air and on Bloomberg, taped by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Adrian, thank you so much. Adrian Wong in Hong Kong. Coming up, a Conservative Party chair, Nadim Zahawi, sacked from the government. We'll bring you the latest on another turbulent few days in British politics. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Welcome back to the Open, everyone. 52 minutes into European trading day. A lot of pressure across the board. European stocks down 0.5% overall. Of course, the picture is markets trying to get ready for a lot of central bank decisions later in the week as they look at Adani and some of the pressure there. And at the same time, we also had that inflation print in Spain that was higher than expected. Maybe a signal of what's to come for the rest of the Eurozone. Now, let's also take a look at some of the events that we're following this week. Of course, we always keep an eye on yields in Europe because that could have an implication of what the ECB does. Maybe more hikes ahead. Now, the ECB Governing Council member, François Villeroy de Gallo, is due to speak at an event in Paris. Now, tomorrow, UBS and UniCredit report earnings. We'll also have the U.S. Employment Cost Index. On Wednesday, it's the Fed's rate decision. Officials poised to slow the pace of rate hikes for a second straight meeting. Now, ISM manufacturing and JOLTS data are also due. That's followed by rate decisions from the ECB and the Bank of England on Thursday. Also, big day for tech earnings, Alphabet, Apple, Amazon, and Qualcomm reporting. On Friday, it's U.S. employment, unemployment, and non-farm payrolls. Now, here in the UK Prime Minister Rishi Sunak has fired Nadhim Zahawi from government following recent revelations over the Conservative Party chair's taxes. Sunak said an independent review showed, quote, serious ethics breaches. Well, joining us now is Bloomberg's Leanne Gerrans. Leanne, good morning. This is yet another blow to the government of Rishi Sunak, who's only been in power for 3 months.
Yes, nearly 100 days now, Francine, and we know this is another blow to him. Yesterday, we found out that Nadhim Zahawi, the party chairman, had been kicked out by Rishi Sunak over these tax revelations that have really come to light and really shifted the mood from policy to look at the controversy that is happening within the Tory party. And we do know that Gavin Williamson, a minister without portfolio, was earlier left the government resigning over an ethics probe into bullying. And now the Deputy Prime Minister, Dominic Raab, is also facing an ethics probe. So things are just not looking good as Tory sleaze seems to be coming back into the party. And this is what Rishi Sunak's been promising to root out.
Yeah, so he has the strikes. He has, of course, he's promised quite a lot from the NHS and now has to root that out. If you look at UK business, we had optimism. That was, quite incredible. There was a Lloyds Banking Group survey and at a 6-month high.
Yes, indeed. So Lloyds Banking Group has brought some optimism, as you say, to the doom and gloom that we have been seeing when it comes to strikes plaguing much of the country. And Lloyds Banking Group, the monthly business barometer, something we do watch closely here, Francine, is showing a reading at a 6-month high. Now, this comes really despite more signs that activity was starting to decline at the beginning of the year. But I just want to say, confidence indicators here in this country right now are sending out conflicting messages, and I'll tell you exactly why. The UK picture was reinforced by a separate survey by the business group, the CBI, which is warning we are heading into recession. And this is really because the private sector activity is beginning to fall. And that's, of course, because of these rising cost of living pressures and because of the strikes we've seen over so many industries. So 2 conflicting reports today, one positive, one slightly not so.
Yeah, I mean, it's quite good, actually, that we have some positive news.
Yes,
I feel like we haven't had that for a while in the UK.
And then hopefully today that we can have some more positive news on the political side as Rishi Sunak is doing the rounds when it comes to the NHS, pledging more money for that too. So let's see what's on the horizon, really, Francine.
Yeah, we think 800 ambulances and like 5,000 extra bed chairs in hospitals. Leanne, thank you so much. Leanne Gerrans there with the very latest on the UK. Now, that's it for the European Market Open. Surveillance Early Edition is up next. We look at full markets, of course, the focus not only on inflation in Spain, but we look at some of the individual stocks on the move. So this is a picture across the board. When I'm looking at Shell, one of the biggest movers in today's trading session, Unilever also picking the Dutch dairy boss as chief executive after Alan Jope's replacement. We did see Unilever under a lot of pressure. There was strategy mishaps, really putting the ire of investors, including Nathan Peltz. So we look at inflation, we look at some of the individual movers. Renault also agreeing to lower the Nissan stake. It's a pretty historic rebalancing. This is Bloomberg. what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Rebutting the rebuttal, Hindenburg says Adani's 413-page response to its allegations fails to answer most questions. The rout in the group's shares hits $71 billion and bonds slide. Fragile sentiment, stocks and futures fall as investors weigh Adani's plunge, China's reopening, and a mega week for central bank rate decisions. Plus, London's future as a financial hub. We discuss fintech and the city with Anthony Jenkins, 10X founder and former Barclays Chief Executive Officer. Now, we're getting some breaking news for GDP in Germany. Preliminary fourth quarter GDP falling some 0.2%. It's a little bit worse than expected. Quarter on quarter, the estimate was of no change. The picture adds to uncertainty about the European economy. We also had that inflation print in Spain earlier on. Of course, this could be an early indicator of what's to come in the rest of the Eurozone. The markets not really taking it in their stride. Shares in Europe declining. U.S. equity futures also declining. Now, there is a note of caution creeping in at the start of the week by interest rate decisions, also big companies reportings in the U.S. European stocks down 0.4%. S&P futures also down 0.7%. We look at sterling. Really, we also look at bonds across the board, not only in Europe, but treasuries on the back of that inflation print in Spain. And the fact that the ECB could be more aggressive in their hiking. Now, let's get on to the European map to see if there's any material difference between, for example, the CAC 40 in France and the FTSE MIB in Italy, down 0.3% across the board. Now, let's get more on Adani. Short seller Hindenburg Research says the group's response to its report alleging fraud and stock manipulation has failed to answer most of the questions it posed. The stock and dollar bonds of many Adani Group companies have continued to drop after the lengthy rebuttal. Adani says the report is bogus and unresearched. Let's get more with Bloomberg's conglomerates reporter, PR Sanjay in Mumbai. So Sanjay, what are the key features of the rebuttal from Adani?
So this is like pretty long, rebuttal of 413 pages, which landed up around late night on Sunday. And largely, they were saying that this report is like ill-timed. It had malintention to derail the, FPO, which is follow-on public offer, which is seeking to raise $2.5 billion from the market. And the follow-on issue is concluding tomorrow, and it has landed exactly on 25th. And they are saying the key allegations were like Adani clearly said that most of the allegations were like actually cleared. They've given in the public disclosure, and out of 20 questions, 16 are like baseless allegation, and they've also said that it's addressing its debt concern by deleveraging and raising equity from the market. And some of the concern which they said, this Hindenburg research report is ignorant about Indian laws and Indian regulatory framework. And Hindenburg research, as a counter in the morning, they said you can't put bloated nationalism in front of any report to evade questions asked by Hindenburg in their 100-page report. Clearly, Adani said these allegations are against not only Adani but against India growth story, putting India ahead of this kind of a rebuttal thing. So now it's getting a tale of rebuttals, like one rebuttal after rebuttal. So story is evolving. It's a developing story.
It seems, Sanjay, it seems to be getting pretty ugly, and actually the rebuttal did not help with the sell-off.
Yeah, $72 billion have been already eroded from market cap of Adani Group of companies, and most of the stocks which actually gained in the first session, reversed, and it's now back in red. And most of the stocks are now, in the red, and one will have to wait and watch because tomorrow is the last day for FPO, and still, interest was like very weak for even HNI and retailer. So, but company sources telling that HNIs are very keen, and towards last day they will be investing, and after HNI's retail investor will also pick up, but one will have to wait and watch.
Thank you so much, Sanjay. Bloomberg's conglomerates reporter, PR Sanjay in Mumbai. We're also joined by Anna Stupniewska, global macroeconomist at Fidelity International. Anna, thank you for joining us. A lot of the focus, of course, this week is not only on central banks, the Fed, the ECB, the Bank of England, but some of the earnings going forward. Has there been too much optimism that a lot of companies can hold on to their margins?
Yes, we believe so. It has been long coming, but we do think that it's this earnings season and perhaps the following earnings season that will put pressure on equities overall, and that pressure from the multiple shocks that we've seen over the past year, over the past few years, will finally show up in the earnings.
Anna, what does that mean for inflation going forward? So, for example, in Europe, if we take region by region, we had that higher than expected inflation print in Spain. This could be a precursor on things changing in the Eurozone as a whole. Is that how you're taking it?
I think inflation dynamics are a bit different across countries. So if we talk about Europe, inflation seems to be a bit less entrenched than what we're seeing in the US. It has been driven a lot by supply side distortions. So even on the core side, for core inflation, there's some pressure from demand side as well. But we do think that the European inflation will decline faster, particularly from the second quarter of this year, than that in the US. But the Spanish print this morning is for sure a signal to central banks that they should not be taking for granted even a couple of successive declines, readings of inflation. Because inflation is sticky, there are factors that will continue putting pressure, like the labor market across the board, which might be weakening but still remains quite strong. And it just says to central banks that they should not be pivoting before they're confident that the inflation has been tamed.
So there's a lot of talk or hope that actually Europe can avoid a recession. Is that still the case if inflation goes back up and the ECB needs to do more?
So we actually think that recession cannot be avoided in Europe or the US or the UK. Europe has avoided the long feared recession, obviously through the winter. We might still see some weakness. It might still be technical, but actually we are very much focused now on the policy-induced recession across the board, and that's about Europe as well. And that's why we believe that Europe will see a recession later in the year. Again, induced by policy, but also by the continuing energy shock that has been induced by the war, because these are all the shocks that are still in the system. And as central banks, as the ECB continues to protect their own credibility by fighting sticky inflation, growth damage will show up. We think it's going to be very difficult to avoid it.
Anna, when you look at some of the difficulties facing inflation, or how you measure it, is there something that you look at to give us an indication, or is really that Spain figure it?
Well, of course, we'll look at different indicators of inflation that central banks also like and focus on, and that is various measures of core 3-month inflation, where those measures, they strip out more volatile components. These are all still pointing to quite entrenched core inflation in the euro area. And also inflation expectations, as you know, very, very important, and that's what the central banks are focusing on. It's a bit less of an issue in the euro area, but I think it is an issue for the UK and potentially also for the US, as some of the survey-based inflation expectations are above target. And actually, when we look at historical relationship of what is important for actual inflation process, actually inflation expectations are very important. It's one of the most important drivers. So that's, again, something to focus on to try to gauge the central bank trajectory over the next few months.
Anna, what's your take on what we'll hear from Jay Powell later on this week? Is he going to sound dovish? Is he going to sound bullish? Or does he just need to walk that tightrope that is so very precarious for central banks right now?
Yeah, so much debate on this right now. Well, we think he's going to be hawkish. It just doesn't seem to us that there is any evidence right now or any incentive for him to suddenly pivot or to be more pragmatic. And I think one of the main indicators he's concerned about is financial conditions. They have eased. They've been easy, well, since the peak, they've been easing for some time. And that means that with all the tightening that they have done, some of that effort might be reversing in the markets. So I think it doesn't make sense. Data, yes, has been weaker, but the labor market remains resilient. On balance, he should be hawkish and trying to get those financial conditions tighter from here.
Anna, thank you so much. Anna Stupnicka, a global macroeconomist at Fidelity International, stays with us. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Spanish inflation has unexpectedly quickened, a snapping 5 months of slowdowns, prompting traders to boost bets on ECB rate rises. Consumer prices advanced by 5.8% in the year to January, well above the 4.8% estimated by economists. The task of forecasters was complicated this month by a reweighting of the Eurozone inflation basket. Now, Israel say it may penalize the families of Palestinian attackers by revoking identity cards and residency if they do support violence. The warning comes after a Palestinian man shot and killed 7 civilians on Friday. That followed a deadly Israeli raid in the West Bank city of Jenin. The rising violence, making January one of the bloodiest months in years, comes ahead of a visit by U.S. Secretary of State Antony Blinken this week. Now, Rio Tinto has lost a highly radioactive capsule somewhere along a highway through the West Australian desert. The mining giant and local government are attempting to find the 8mm long widget, which is a component used to measure the density of iron ore. While the risk to the general community is indeed low, exposure to the substance could cause radiation burns or radiation sickness. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne Gerrans. Coming up, a crashing global chip demand is actually threatening earnings as another major chip maker is set to report tomorrow. We have the details next, and this is Bloomberg.
out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, global chip demand has slumped with the $160 billion industry suffering one of the worst routes ever, threatening to wipe out earnings. Key memory chip maker Samsung posts results tomorrow. Well, we're back with Anna Stupniewska, global macroeconomist at Fidelity International. Anna, when we look at the global chip industry, we didn't have enough of the memory chips, now we have too much. Is this a problem with the industry and the way it's done, or is it really a barometer of what kind of world economy we'll be left with?
I think from a macro perspective, from where I sit, this tells us that those supply chain disruptions that we have seen since COVID or due COVID are indeed unwinding. When we look at a number of different indicators, and some of them do include chip demand, chip supply, they do show that these restrictions are very easy now. And so that is feeding into inflation, absolutely, and our understanding of inflation, because it's the supply side components of inflation that they have been driven by the supply side disruptions that are easing and will probably be easing faster than those on the demand side. And so, yes, this tells us that we are looking to less inflationary pressure going forward from the supply side shocks.
And talk to me a bit about Japan. So we have a lot of experts, including a panel actually of expert coming out saying the Japanese government and really the central bank should revise this joint policy statement and make an inflation target a long-term goal. Is this 100% the way we're headed, and will this happen after Governor Kuroda steps down?
Well, as you know, a lot of speculation in the markets and consensus is, I think it will happen after Kuroda steps down. They will exit YCC and negative interest rates. And I would say, as a narrative, it works. And it's hard to disagree, because at some point inflation will probably be higher and will signal enough momentum for the BOJ to signal that they might exit the super accommodative monetary policy. However, we do worry about the risks around that. As we know, the YCC in Japan has been the anchor for global yields for many years. The exit from this kind of policy is going to be exceptionally difficult, not just for the Japanese markets themselves, but we think also potentially the spillovers to the rest of the world at the moment are probably underestimated. So it's in terms of where capital flows, and we've already seen some outflows from Europe, especially going back to Japan, and potential market stresses. So we do think this is one of the risks to watch. The narrative makes sense, but its execution, I think, is very uncertain.
How's uncertainty for Bank of England policy? So we have a big decision coming up. Is, Governor Bailey going to get it right, or is there a real danger that they overhike and that we're going to see an even longer and protracted recession?
I don't know if he's going to get it right, or depending on what he's aiming for. But looking at, again, the labor market and wages and inflation expectations, it makes sense for them to continue hiking and to be hawkish against the background of the economy going into recession. So again, it's about central banks protecting their credibility, fighting inflation that is sticky, and producing that growth damage. So again, we think it's likely that the UK will go into recession as it is fighting this very tight labor market, not just because, as a consequence of COVID, but also as a consequence of Brexit.
Anna, thank you so much for joining us. Anna Stupniecka, global macroeconomist at Fidelity International. Now, coming up, as Conservative Party Chairman Nadhim Zahawi is sacked from government, we'll bring you the latest on another turbulent few days in British politics. This is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. UK Prime Minister Rishi Sunak has fired Nadhim Zahawi from government following recent revelations over the Conservative Party chair's taxes. Sunak said an independent review showed, quote, serious ethics breaches. Joining us now is Bloomberg's Leanne Gerrans with the very latest. So, Leanne, this is another blow to Rishi Sunak's government, been in power only for 3 months.
Yes, he's coming up to his 100 days and the top dog in Downing Street, Francine, and it's not looking so good, is it? Yesterday, we do know that, of course, Nadhim Zahawi was fired as the party chairman over these revelations about his taxes, which have been causing controversy for a fairly long time at the moment. And the Labour leader has said that the Prime Minister has looked really weak over this because he didn't fire Zahawi earlier when they did hear about this. Now, I just want to go into the fact that the Tory party chairman did acknowledge that he was careless with his taxes. And Francine, he actually paid over £5 million to HMRC, and this was all to do with the sale of shares in the company that he co-founded with his father, which is YouGov, which ironically, YouGov is a big polling company here in the UK, which we know, and that's showing that the opposition Labour Party is well ahead of the Conservatives in the polls. And I think this latest scandal is really not going to help Rishi Sunak when it comes to that.
So what does that mean for the economy? I don't know whether this is a distraction or this is a significant problem for Rishi Sunak's standing.
So this is a bit of a distraction. I think it's easy to put it that way, and a lot of the MPs themselves feel like that. Like Bim Afalami, one of the Conservative MPs, has come out and said it has been a distraction, especially away from policy, and at a time, Francine, where we've seen this country grind to a halt because of strikes. We've had ongoing strikes. It's difficult to get into work. The trains are on strike. Also, when it comes to the NHS, we've seen nurses and ambulances on strike. Well, Rishi Sunak has had to bat away allegations about Nadhim Zahawi. Also, Gavin Williamson, the Minister without portfolio, he also went recently, and that was over an ethics breach, into bullying. And now it looks like the Deputy Prime Minister, Dominic Raab, could be facing the same thing. So instead of getting into policy, we are seeing Rishi Sunak here having to battle things. And we know he didn't go to Davos. You were in Davos. And instead, the Labour leader, Keir Starmer, went along with Rachel Reeves. So Rishi Sunak's really been at home trying to shore up his position.
Yeah, I mean, Davos is probably also not a good look for the billionaire Prime Minister, so that's also probably why they stayed away. What does that? We actually also had optimism at a 6-month high very quickly. I mean, this is finally some good piece of news.
Yes, it is a good piece of news. So we have some optimism, and this is from the Lloyds Banking Group month. So Lloyds Banking Group. So they're saying that optimism is at a real 6-month high, and this is despite more signs that the economy is declining. However, on the other end of the spectrum, CBI warning of recession. So 2 different surveys coming out there today.
Leanne, thank you so much. Leanne Gerrans with the very latest on the UK. Now, we'll be covering all things UK every week on Thursdays at 9:30 in our half-an-hour special. Coming up, the British Chancellor, Jeremy Hunt, wants to turn the UK into the world's next Silicon Valley. How viable is that? This is Bloomberg.
CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
News breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Hindenburg says Adani's 413-page response to its allegations fails to answer most questions. The rout in the group's shares hits $72 billion and bonds slide. Fragile sentiment, stocks and futures fall as investors weigh Adani's plunge, China's reopening, and a mega week for central bank rate decisions. Plus, London's future as a financial hub. We discuss fintech and the city with Anthony Jenkins, 10X founder and former Barclays chief executive. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. The British Chancellor Jeremy Hunt has argued that leaving the EU can be a catalyst for prosperity for the UK. At a speech at Bloomberg's European headquarters here in London on Friday, Hunt vowed to attract the world's tech entrepreneurs and green technology firms. Now, he said his ambition is to turn the UK into the next Silicon Valley.
I think we have the opportunity with our universities, our financial services, and our technology strengths to be a Silicon Valley.
Here with us, Eileen Burbidge, partner at Passion Capital and UK Treasury Special Envoy for FinTech. Eileen, thank you so much for joining us. There's so much going on in the world of tech, and Jeremy Hunt definitely put that at the forefront. I feel like in the last 3 years, maybe the UK government has left tech to one side a little bit. Is it now a little bit too late?
I don't think it's ever too late, and it's better late than never. But I do think clearly the government had so many other priorities over the last few years that I think, I've been on a few times talking to you about the momentum that we had maybe 2015, 2016, when we had the coalition government, and a real emphasis on things like Tech Nation and other things. And of course, when I was appointed as Treasury Envoy. But I do think coming back to shine a light on the tech sector, especially when you're talking about productivity, skills, and the economy in general, is the right thing to do. The question is, where's the sort of detail, where's the meat in the policies to come?
So what's needed? Is it golden visas? Is it, I don't know, taxation? How do you make it work?
Yeah, I think there's a number of things. I think the first thing is probably to try and emphasize skills training both domestically and attracting skills from abroad. So to your point, I don't know if it's a golden visa. I don't know if we continue or expand the current global entrepreneur visa that we actually started here in this country a couple of years ago. But there clearly needs to be a lot more signposting about how the UK is welcoming to people coming from abroad, and also an emphasis on skills being taught more here as well.
Eileen, what does that mean for where the UK can actually excel at? So are you also having conversations with the Labour Party, given how far ahead they are in the polls right now?
I mean, we talk across government as investors, right? We're opportunists. And so we're going to speak to whoever might be able to influence policy for sure. But I think fintech is the right emphasis, and you've got Anthony coming on shortly. Absolutely, the fact that London and the UK has always had such a rich heritage of financial services makes a lot of sense to double down on and start to try and improve in terms of digital enablement. But there are so many other areas, such as education, such as the climate, such as actually just ways of working and everything else that we do so well here in the UK.
Is Brexit a help or a hindrance?
I'm not supposed to really probably go into too much. You don't have enough time for my opinion on that.
We have 3 hours. We're extending the program.
I don't think it helped. I think that, as I said, I'm an investor, I'm an opportunist, so there's always opportunity in challenge. I think there are some things that could be done to probably make the most of where we are now. And I think it was a double whammy, frankly, with Brexit and then the pandemic. And so there's a lot of work to do to try and bring it back around.
Is there an area in fintech that looks especially attractive right now to invest in, that the UK can also capitalize on?
Yeah, I think fintech is so broad, and that's what I'm excited to see, and I feel has been validating over the last 5, 6, 7 years. Initially, you saw a lot of fintech innovation on user-facing experiences, so retail banking, the likes of Monzo Bank, Starling, Tandem, even a Revolut, for example, even giving people access to other assets, whether that's cryptocurrency or other types of property investments and the like. What I think is really interesting as an investor now is going sort of further up the stack, as we would describe it, or deeper into the plumbing and the back end and what might enable enterprise financial services.
And that looks like what? So who's doing the right things? What are you investing in?
So there's a lot that's to do with what we call terrible labels. We ascribe to these things, but reg tech, so regulatory tech, compliance, KYC, sounds really boring, really unsexy, but it's going to save, it saves enterprises so much money. It's really, really important. And we have the opportunity to probably, lead in the world here from the UK.
So this is basically the pipeline, right? That no one really, you say it's boring because no one really pays attention to it as long as it works. Who's that rivalry?
Who's that? I'm sorry.
Right. Is it a rival to someone? It's not.
I don't know
it's
if it's
the back end.
Well, I think that any other destination in the world that has financial services heritage, so you could take Frankfurt, you could take New York, you could take Hong Kong, for example, they will all be seeing the same challenges, right? So we have trillions of dollars that actually get exchanged in London every day just for Forex. So that's why here in London, we should be closest to the problem and the challenge as well as the opportunities, but any other financial hub will have the same.
Is the UK struggling to attract talent because of the cost of living, or is that really a London problem? So are we going to see more hubs up north in the UK?
I mean, I think there's always been really great hubs in fintech, for example, Edinburgh, for example, up in Newcastle, up in Leeds, and so that's great. We should start capitalizing on that much more. We are closer in distance to those other cities here in London than, say, Silicon Valley is to New York, and that's one of the advantages and one of the strengths that we've had for the last few years. We do, again, need to double down on that. Having said that, you need to acknowledge that every single city and tech hub around the world has a skills shortage. It is not just here in the UK and just London, but it just means we have to compete even more.
Eileen, and I know we always talk about, some of the the Googles, the Facebooks of this world, and the Microsofts. We're seeing huge layoffs across the board. Was this downsizing because they just became too big? Does this make sense to you? Or is it a bit of a, change in shifts for a lot of these companies?
Yeah, so I don't think it was a change in shift or a change in strategy or even an aggressive, about face. I do think there was a lot of hiring in the last couple of years coming off the back of the pandemic. And for example, when Meta announced its layoffs last autumn, actually the number of people it was looking to affect, or unfortunately, that would end up losing their jobs, equaled the same number of people they had hired between February and August just last year. So we're not even talking about sort of dialing back what had been happening over the last couple of years. At that instance, it was, let's look at what we did for the last 6 months, and maybe that represented, on top of everything else for the last couple of years, a bit too much optimism, and let's just slow things down a little bit.
But so it's not a change in direction?
No, I don't think it's a change in direction at all.
Some of the web services?
Not at all, not at all. I do think as soon as, we start to talk about inflation coming down, the sort of conversations about a macroeconomic, recession or global recession sort of going away or dissipating, the companies will continue hiring again, and even more aggressively, because they're competing with one another.
AI is all that everyone's talking about, partly because of ChatGPT, but also other applications. Yeah. Is it too late to come into AI right now?
I don't think it's too late. And again, there's always opportunities, whether you're going to be part of the infrastructure and the plumbing and actually the design, or whether you're going to be bringing interfaces into users, new experiences or new channels. So it's not too late. I do think with artificial intelligence, and something that the government has signaled they want to do, but we need to see the action, there's a lot to do with, I think, regulation or at least governance with respect to AI and ethics. We want to make sure that we don't have too many unintended consequences, and that's really important.
How do you make the difference? So one of the most interesting panels actually in Davos, and it was the most there were two oversubscribed panels. One was on chips around the world, and the other one was on AI, dark AI. So for example, costumes that simulate being shot, and the good AI, so some of the protein folding and things like that.
Yeah, and so it is hard to distinguish, right? It's sort of like, I mean, maybe this is going to sound too extremist, but, you know, it's a bit like when we first came up with the technology to build the atom bomb. You know, you have great power, great ability in order to affect change. I'm sure the people that are thinking about all the use cases now think about how it can help and what it's used for good. And we just need to think about, again, what the unintended consequences could be as well, and make sure we have governance and checks in place to sort of stop every once in a while and say, are we happy with how this is going, or how this could also be applied?
Eileen, as always, thank you so much for joining us. Eileen Burbidge, partner at Passion Capital and UK Treasury Special Envoy for FinTech. Coming up, don't miss our exclusive conversation with Anthony Jenkins. He's chairman and founder of 10x Futures Technology. We'll follow up, of course, on some of the FinTech that we were talking about with Eileen. He's on a mission to build better banks. This is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's carry on the fintech conversation. One-time establishment banker Anthony Jenkins is on a mission to upend the finance industry. The former Barclays chief executive now leads 10x Banking, a startup he founded to provide the technology behind everything from current account to loans. Now his ambition is to serve 1/10 of the world's population. Well, Anthony Jenkins, 10x Banking founder and chairman, joins us now for an exclusive conversation. Anthony, thank you for joining us. I mean, you've gone from strength to strength in terms of some of the offerings and backings and investors. Where do you see the most opportunity now in 2023?
Yeah, so if you think about financial services, the sort of mainstream players there, they haven't gone away. If you remember sort of 2015, everybody was predicting the fintechs would destroy the big banks. That hasn't happened. But what's happened is that the big banks themselves have come under increasing pressure. On the one hand, the fintech industry has defined a much better user experience, which the banks have to match. And on the other hand, of course, the big data companies are out there using data more and more effectively. So banks need to respond to that. And basically what I did when I left Barclays was I built all the technology I wish I'd had when I was running Barclays, because I never had the technology I needed to serve my customers, but equally more important to do that cost effectively and generate a good return on capital.
But is that still the case? So since you left, I imagine some of the big banks thought, look, we can do this in-house if we're going to have a competitive edge compared to our rivals.
Yep. So many banks have tried to do this in-house, but in reality, it's very specialized work. This is all we've done for almost 7 years. You know, we have a maniacal focus on making banking 10 times better. And so we've built a platform now where we can literally stand up the alpha version of a new bank in months. We did that twice last year in 2 different parts of the world. And so now we're providing an alternative for banks. Many will want to try and do this themselves, but they could also come to us. And I guarantee you they'll do it at a 10th of the cost and 10 times faster than trying to do it themselves.
And Anthony, and this is, so your name doesn't appear in any of this, right? We also spoke to a company that opens accounts for most of the big banks, but no one knows about them. So does it makes banks, I guess, a commodity. Does it give them an edge using you, or is it like just a back office?
What we do is we provide them with a toolkit that allows them to deliver great user experiences to their clients at much lower cost, and crucially use big data to make better decisions around marketing, credit, and so on. So it's a real competitive advantage, and the bank can focus on what they're good at, which is what customers do I want to serve, how do I serve them, what's my risk appetite, you know, what's the user experience, those types of things. And increasingly, I think the agenda's being set in financial services, not by banks themselves, but by other aspects of our lives. I mean, we expect our lives to work on our phone all the time, right?
I know, and all of our life is on our phone. I don't know what we do without our phone for even an hour. Anthony, what does that mean for cybersecurity? Is that your biggest concern?
Well, of course, everybody has to worry about cybersecurity, and it is a very high priority for us and, of course, for our clients. And the new world that we operate in, the cloud-native world, has many advantages around cybersecurity, because a lot of the old technology, you're talking about mainframes, which were set up 20, 30, sometimes 40 years ago, very hard to protect. But, you know, the banks have done a good job in protecting them. Cybersecurity is an area where you need constant vigilance. You know, you can never rest. You always have to be ahead of where the bad guys are going.
I know your first investor actually was a Chinese company. Things have changed in geopolitics. Would it be much more difficult now for a Chinese company to invest in UK fintech?
Well, I mean, Ping An, who was the investor, wanted to set up a fintech fund, essentially. We were their first investment. And, you know, obviously the geopolitics has got more difficult. But they're looking around the world for great businesses like ours, and, you know, I'm sure they'll continue to find great opportunities for them.
Is there a part of the world that you're most interested in, that either wants your services or also just wants to be an investor?
Yeah, exactly. So, I mean, Asia continues to be a great growth opportunity for us. You know, it's still underbanked, even though there are many banks there. It's got a fast-growing, relatively young population, so that's a big focus for us. And we have some clients in Australia that gives us a bridgehead. We're also working in Africa. We think there's opportunities in Africa, but mainstream Europe is also a good opportunity for us, because many of the banks there have the same challenges. And what we've realized is we only have to build it once. We build it once, everybody can use it, and they all get the advantages of that.
I remember in many of our conversations through the years, you've always been warning about automation hitting a lot of banks across the world, and now we're seeing a lot of job losses at Wall Street banks. Is that coming, or is it just because they were too big? They had hired too much in the last 2 years?
Well, there's always the cyclical and the structural, right? So I think what's happening on the Wall Street investment banks is probably more cyclical than structural. But if you look at what's happening in retail banking, you know, branch closures. There used to be tens of thousands of people who worked in branch networks for big banks, not just here, but all around the world. And those jobs have just gone away. Why? Back to what you said before, because we do our banking on our phones now.
So what are some of the pitfalls? I know you worked, I think JP Morgan, we saw Goldman Sachs, you know, trying to get into that digital retail push. Is there, I mean, you see a lot of these big banks from all angles. Like, is there a common mistake? Is there something that, you know, Goldman Sachs shouldn't have gone into?
We always say that this is about finding what we call a 10x shaped problem, and that's a bank that wants to do something that isn't just marginally better, that is on some level transformational. and crucially has the support of the very senior leadership in the banks. I mean, this is not unique to banking, right? You look at the incumbents in any industry, they always struggle. You know, why didn't Blockbuster, you know, build its own Netflix? It had massive resources, it could have done that. Why didn't Kodak roll out digital photography? It invented it, but it didn't. Most of this is to do with cultural issues, politics inside the banks, where the economic center of gravity sits. And so the essence of this type of work is really to find leadership teams in banks who recognize that they have a great opportunity if they take a more adventurous approach to solving the problem.
But how do you not make, I mean, how do you make sure that you're not living a Kodak moment? If you're a big banking chief executive, there's always a danger that there's a big trend that passes you by and you don't seize it.
Yeah, so this is where I think the critical thing is now to get in the game, because this is all about building the organizational muscle that allows banks to transform themselves over time. It's a different way of operating. There are tens of thousands of people in technology organizations in banks working with quite outdated technology. That needs to change, and that needs to be led from the top.
Anthony, when you look at the UK, so we had the Chancellor here at Bloomberg on Friday talking about the UK and especially London as a future for fintech. What does the government now need to put in place to make your job easier?
Well, I mean, it always comes down to infrastructure, skills, access to capital, and regulation. Those are the things. Now, you know, I'm a huge supporter of the UK in this regard. I think we often sell ourselves short in terms of what we've been able to achieve in the technology space. But there are many opportunities in front of us, and we just need to create the conditions to go and seize them. So let me give you an example. I know flexible working is controversial, right? But actually, in my business, I'm able to employ people all around the UK, and I can employ people in the areas that are relatively deprived, that people want to level up. So why not incent companies like mine to hire people in those areas? I don't need to go and set up a whole office there. I just need to go find folks.
But through what? So is it tax breaks?
Yeah, some sort of tax break, some sort of incentive to do that would be very helpful, I think. That would allow us to shift the centre of gravity away from places like the UK, Oxford, Cambridge, places like London, Oxford, Cambridge, Manchester, where we've already got these concentrations. So we could move jobs. We don't have to move businesses. We can now move jobs. That's one of the great opportunities. The other thing that I'm very excited about is this whole idea of how do we save households energy? And that's really a three-pronged challenge. You've got to be able to create a supply chain of kit that sort of insulates homes. You've got to have people who can install that stuff. But most importantly, there's a fascinating financing opportunity there because the payback on these things is long. So you need to be able to finance it. But of course, people move house. So why should I spend money insulating my home if I'm going to move in 3 or 4 years' time? So again, you know, we could create some regulation around that, possibly link it to, say, council tax, where you might pay a bit more to council tax, fund it that way. Capital markets would put money on the table to, you know, securitize those sorts of assets. So there's a lot of things we can do. We do need to double-click down a couple of levels, though, and get into what's really going...
It's always the detail.
Exactly. What are we going to do different to make this happen?
We're seeing huge layoffs in tech, in big companies. What does that mean for your business?
Look, I mean, I was in the States in the late 90s, early 2000s, right? Everything, you know, has these cyclical bubbles. Yeah. Companies go out there, they hire a lot of people, and then they recognize they've hired a few too many, and then they have to lay them off. Now, that's terrible for the people affected, don't get me wrong, but there's still huge numbers of jobs in tech, and the demand for jobs in tech is always going to be there. So I actually think that these sort of downswings in cycles are better for businesses, because when you're building a business like I am, where you have to be very, very disciplined on how you use your resources and cost, that makes you a better business when the upswing comes, and the upswing will come.
Anthony, thank you so much for joining us. Anthony Jenkins there, chairman and founder of 10X Banking, on a conversation, of course, on the UK and on fintech. Coming up, it's a big week for central banks with the Fed's meeting taking center stage. The BOE and ECB decisions also on the agenda. So we'll have plenty more on that next. This is Bloomberg.
Coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
This is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's take a look at some of the other events we're following this week. Today, ECB Governing Council member François Villeroy de Gallo is due to speak at an event in Paris. Tomorrow, UBS and Unicredit report earnings. We'll also have the U.S. Employment Cost Index. On Wednesday, it's Fed rate decision, ISM manufacturing and jobs data also due out. That's followed by rate decisions from the ECB and BOE on Thursday. Also, big day for tech earnings. Alphabet, Apple, Amazon, and Qualcomm are reporting. And then on Friday, it's U.S. unemployment and non-farm payrolls. This is the picture for the markets. A lot of the focus not only on what's happening in Spain, that inflation print, but the Adani route hitting some $72 billion as the fight with Hindenburg is intensifying. So let's look at some of, first of all, the bond yields that are moving. Two things that we found out this morning. First of all, inflation in Spain unexpectedly jumped. This is boosting rate bets for the ECB, and also Germany may still see a recession after that fourth quarter contraction. So we're seeing a big move, or a move, maybe not a big move, but a move for the 10-year yield in the US, in Germany, and the UK. The other stories that we're watching, three stocks, Unilever picking the Dutch dairy boss as chief executive after a tangle with investors, including Nelson Peltz. After the appointment of a new chief executive, Unilever gaining 0.7%. Renault also agreeing to lower Nissan's stake in the historic rebalancing, down 2.8%. And we're also seeing some changes at Shell. The stock pretty much unchanged. The Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kaylee Lyons in New York, and Edwards here in London. And this is Bloomberg. is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40-year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
I don't think this is a time to be taking possibilities of rate hikes off the table. At the same time, I don't think it's a time to be committing to rate hikes.
I think the market is probably severely underpricing what the Fed may say. I think they are likely to be more hawkish.
I just don't see them stopping or pausing anytime soon.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Stocks and futures fall as investors wait to see what the Fed, ECB, and BOE do this week. An unexpected jump in Spanish inflation boosts ECB rate bets. The Adani sell-off gets worse. Companies controlled by Asia's richest person have now lost $72 billion in market value since the short seller accused the businesses of fraud. And Renault has agreed to lower its stake in Nissan. It's a move aimed at ending a source of friction between the two automakers as the industry prepares for historic change. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, it seems this Monday, investors losing their nerve a little bit as we head into a really busy week when it comes to rate decisions.
Rate decisions and mega cap earnings as well. So there is going to be a lot for markets to digest. And as you say, Anna, we are not starting the week off on a very positive footing. Of course, this is also the week that China has reopened after a week-long break for the Lunar New Year holiday. And Chinese stocks were higher on the day, but they really lost a lot of ground as the session went on. Opened up about 2% higher. By the end of the day, we were right around session lows with a gain of less than 0.5% on the CSI 300. And Chinese technology stocks in particular were really weak in Hong Kong. The Hang Seng Tech Index down about 5%, which was its worst day going back several months to October of last year. And of course, since the lows in October of last year, this is an index that has rallied more than 70%, at least before today. So we gave back some of that really remarkable rally, maybe a little bit of profit taking, or investors expecting that the peak for these names may already be in. Then, of course, the other story we continue to follow in the stock space in Asia is in India, specifically with Adani Group stocks. Adani over the weekend publishing a rebuttal that was more than 400 pages long, pushing back against the claims made by Hindenburg last week, saying they were an attack against India itself. It's interesting to see this playing out in the market today. The enterprise Adani Group stock is up nearly 5%, so a bit of a rebound happening there, but some of the other related firms are still down quite heavily, like Adani Total Gas, down another 20% on this Monday after a 20% drop on Friday. Matt, when you put it all together collectively over the last 3 days, we have seen about $70 billion in market value wiped out of Adani's firms.
Yeah, and I think everyone's been paying very close attention. This is a fascinating saga for us to follow in markets. In terms of U.S. markets, we see futures down pretty substantially this morning, off 0.9%. Okay, we had a positive cash close on Friday, up above 4,000. I think 4,070 is the level we hit on Friday, but we're coming down heading into this very busy week of central bank decisions, economic data points, also going to be weighing on markets if they come in wrong. U.S. 10-year yield rising about 3 basis points as investors sell that debt. 353 is the level we're looking at right now on the 10-year, and NYMEX crude comes back down under $80 a barrel. So we see that move down for West Texas Intermediate to $79.27. Bitcoin is down right now 2.7%. So that looks fairly substantial, but we have to remember that Bitcoin trades 24/7. So it's down from a high that it hit yesterday evening of almost $24,000. It's still up from the Friday close. Anna, what do you see in Europe?
Well, here in Europe, Matt, one of the worst performing sectors is around technology. And this really links back to the Asia session as China mainland traders come back to their desks after the Lunar New Year holiday, selling some of the names that have done well recently. So Chinese tech was down, Hong Kong tech down in particular. That weighed on Tencent, which therefore weighs on Prosus. You can see the AEX is down by 1.2%, and Prosus is one of the big movers on that market because it has a big stake in the games maker and other things over in the Chinese market that is Tencent. Here we're focused on the macro, though, as Kaylee and Matt were both pointing out, a big week in terms of the inflation story, the fight against inflation. Central banks around the world is still in hiking mode, even if at slightly reduced levels in some cases. But we start the week with a warning about what's at stake here in terms of inflation. More on this from our colleague Maria Tadeo in just a moment, but 109.07, so a jump in the euro as a result of that higher than expected inflation print coming through in Spain. On to some corporate earnings stories. Philips numbers coming in well ahead of estimates, much better than had been anticipated. Also some job cuts in the mix there from the Dutch medical devices maker, down by 5.8%. Unilever, a change at the helm of this Dutch business, Anglo-Dutch business, up by 0.7%. The new guy who they brought in, he's been on the board for a little while, but essentially an external appointment, Hein Schumacher, not very well known to analysts it seems, but everyone giving him the benefit of the doubt. He only takes over in July. And Renault in focus. Again, we'll get more on this in just a moment. That stock down by 2.5% as they reduce their stake in Nissan. This story goes back a long way, but analysts looking forwards are asking what this really means for the actual on-the-ground relationship between these alliance buddies in this business. So we'll certainly get more details on that in a moment. Now, Bloomberg's Maria Tadeo joins us from Brussels to take us through some of the inflation narrative. Maria, Spanish inflation then, surprising to the upside. We expected a drop down from something with a 5 handle to something with a 4. Instead, we got a jump up. What does this mean, this warning for the broader euro area?
Yes, Anna, and look, today I come in particularly handy because on Thursday I'll be, of course, at the European Central Bank. It's their decision happening that day, but also this is Spanish inflation. This is a number that I used to cover for years when I was a print reporter, and I think to me there's 2 things that really we should highlight on this. First of all, you mentioned it. It's a 5.8 acceleration in inflation in January. The expectation was that we would see a cool down in January. That is not the case. When you look at core inflation, that is also persistent and sticky. And to answer your question, what does it mean for the euro area? A lot of market players really like to look at Spain as a forward-looking indicator for the rest of the Eurozone. And I think right now, when you hope, or if you were hoping for a peak inflation story, well, today, clearly, you're not getting one. In fact, it's the opposite. It's an acceleration in pricing.
So, Maria, from the days of, you as a cub reporter in Madrid to now covering all of Europe for us, out of Brussels, out of Frankfurt, I guess later this week, what does it mean for the ECB? Because we've been hearing so many voices, so many hawkish voices. They seem louder than the doves saying, stay the course.
Yeah, you know, in particular for me, it means a lot more work and a lot less sleep. But what really matters is the European Central Bank. Look, Matt, I think when you look at Thursday, everyone that I speak to, every economist, every ECB watcher says it's 50 basis points. No question. They have no choice. Essentially, the market has been so well guided to it that not doing that would be a communications disaster. Plus, you have the data coming in today. I think the real debate is about March. Will they hint in that press conference at another 50 basis points hike, or will there be nuance in the language? Some were expecting that there could be because the data had been better than expected in December over the Christmas break. But of course, when you look at the inflation number today from Spain, that could, or you could argue, will embolden the hawks to say, we're not done. This is hit and stay the course.
All right, Bloomberg's Maria Tadeo, looking forward to your reporting on the ECB later on this week. Meanwhile, let's get back to the story in India. Billionaire Gautam Adani's attempt to restore confidence in his business empire is falling flat with investors. Shares of most Adani Group firms are slumping again today. The sell-off has now erased about $72 billion in market value. Bloomberg's PR Sanjay joins us now from Mumbai with more. So, PR, it doesn't seem that 400-something page rebuttal really worked.
413 pages to be precise, and of 88 questions posed by Hindenburg, Adani said 68 refers to the matter has been already disclosed to the public, and out of 20, 16 refers to public shareholders and source of funds, and 4 they said it's simply baseless. And the last part was very interesting. That this report is not against Adani but against India to mislead the global investors against India growth story. So, but these rebuttals, the 430 pages rebuttal, could not help Adani to arrest the erosion of market wealth. They've lost 72 billion, and some of the companies, of course, gained a bit, but most of the group companies erased the gains and back in red.
What happens next then on this saga, do we think? Because, I mean, we've heard from Adani with this many pages of rebuttal, as you say. Hindenburg says this doesn't answer our questions, and investors continue to sell the stock.
Oh, that's an interesting question. Tomorrow is the last day, a D-Day for the follow-on issue, which is seeking to raise $2.5 billion. And we spoke to Adani sources and CFO. They're saying that still there is a huge interest from HNI, high net worth individuals. And once they put in money tomorrow, retail investors will be back, and they are very hopeful about to conclude this follow-on issue successfully. Let's wait and watch. It's a developing story.
PR, thanks so much for your continued coverage. Bloomberg's PR Sanjay reporting live from Mumbai on the Adani saga. Now let's get to another one involving French and Japanese car makers. Renault has agreed to lower its stake in Nissan to 15%. The move equalizes their cross-shareholding partnerships in a revamped alliance. Joining us now from Paris is Bloomberg French transport reporter Albertina Torsoli. So, Albertina, after months of drama, years really, we're finally nearing an historic agreement between Renault and Nissan. But Renault shares are down. Why is that?
Yes, finally there, but not yet there. The 2 board meetings will take place in the coming days and still need to approve this historic deal between 2 companies that had really many troubled years. As you point out, everyone will remember the spectacular downfall of then Alliance leader Carlos Ghosn. Today's step is a positive one, but really confirms what Bloomberg had reported January 26 on agreement at top level having been found. But we are missing all the details. There's one detail in particular that is missing, and as you well know, God is in the detail. How much Nissan is willing to invest in Ampere. All this is happening because Renault and Nissan need to move on with their strategy. In particular, Renault is splitting up its business in 5 units. Ampere is the future, really, of Renault. It's its electric vehicle business, and Nissan will back it, but there's been a lot of months of discussion on valuation of Ampere, how much Nissan will invest, and of course, Ampere will be IPO'd one day. You really need your alliance buddy, as you call them, to back you up on that, and we still don't have that information. That's the disappointment
absolutely.
today.
So, Albertina, so we look ahead to see if we find that, see what we find in the detail, the devil or otherwise. Give us some more details of what the next steps will be then here, because yes, some analysts are saying that this is the crucial piece of the data puzzle, or the puzzle that is now missing, just what kind of involvement they'll have in the new EV business.
Yes, we are expecting the boards of the respective companies to meet in coming days. I don't think there will be particularly any issues Renault's side, but Nissan, Nissan, some people at Nissan, some executives haven't been totally convinced by this plan. We have gotten to a good place today. The independent directors of the company gave a nod on January 17, but the contract has to be signed. As soon as that is signed, there will be, from what our sources are telling us, a meeting in London, an alliance meeting in London, expected February 6th, so next Monday, a week from now. Everyone will be flying into London to, pitch this new deal to investors. But until then, we have to hang on and wait.
All right, we'll wait and see how that goes next week. Or the week after. Math is hard on a Monday morning. Bloomberg's Albertina Torsoli reporting from Paris. Thank you so much. Now let's get back to some stocks moving here in the U.S. We're watching in pre-market trading. There's a few groups I want to point out, one of them being Chinese technology stocks. As Anna and I both mentioned, it was a really weak session overnight in Asia. And so the U.S. ADRs are really following that in the pre-market session here stateside this morning. Alibaba's ADR is down about 6%. JD.com down about 5%. Bilibili down about 7.5%. You're seeing weakness elsewhere in tech as well, including in the semiconductor space. Remember, we're getting more reports from some of these names like AMD. That will be reporting tomorrow. It's down about 1.6% today. Ahead of that, NVIDIA down about 2.4%. And Intel, after a 6% loss on Friday, after it gave a disappointing outlook, really quite terrible outlook, is down again, down about 2% before the bell. Then when it comes to some of those larger cap tech names, you're seeing weakness there too, including for Tesla, which rallied 33% last week. Its best week since 2013 after it reported results, but giving back some of that gain, down about 1.5%. And you have Amazon and Apple each down more than 1% as well. Of course, we're waiting for their results later this week, Anna.
Yeah, absolutely incredible moves on Tesla, incredible moves on the NASDAQ really last week, really catching up with some of the other outperformers of 2023. Coming up, Ben Gutteridge joins us. He'll give us his perspective on the year-to-date market performance. Invesco Asset Management Director of Portfolio Services, he'll be with us shortly. And Wall Street is losing out to the amateurs, it seems, in the US real estate slump. Read more of today's big take story online or on the Bloomberg terminal. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
A pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller here in New York at Kayleigh Lyons. Anna Edwards with us out of London. And it is Fed week. So we're looking at market pricing right now for a terminal rate, an effective terminal rate of 4.9%. That really translates into an upper bound of 5%. The Fed has forecast its own terminal rate with an upper bound of 5.25%, or an effective rate of like 5.10, 5.17. In any case, it looks like the market doesn't think the Fed can actually get there. Joining us to talk about this is Ven Ram, Bloomberg cross-asset strategist. Ven, I guess give us your preview of what to expect from the meeting and the decision on Wednesday, and why do you think the market continues to push back?
Morning, Matt. I think that everyone's expecting a 25 basis point increase at this point, and I think that's what we will get from the Fed on Wednesday. I think what will be the key to the markets is the messaging from the Fed, and I don't think Powell is going to quite say, yes, there is no need to take rates to 5.25 as our dot plot showed, simply because there's too much uncertainty about the path of inflation. Yes, we have seen inflation moderate, but at current levels, inflation is still way more elevated than it needs to be. It's nowhere near the 2% target. And that's what Powell will hammer home on Wednesday. And that fact is kind of lost on the markets. The markets are looking at the economy. Yes, we already know that the economy is going to weaken, is going to soften, and that is what it is doing. The Fed has that in the back of its mind, but it's not going to recant its strategy just yet for the reasons I mentioned, because inflation...
Yeah, I was just going to say, so yes, we'll wait to see what the narrative is, what the story is that the Fed tells, Ven, as you were setting out there. Let me ask you about the ECB, because we're going to hear from the ECB as well. The euro jumping on that higher than expected, hotter than expected Spanish inflation data. Does this have broader read across, do you think, Ven?
Absolutely. I think that, we have been hearing pretty much from all the ECB officials in the past 10 days or so, even before this morning's print, saying that, look, rates need to be at much more restrictive levels. And if anything, this morning's Spain's inflation beat suggests that there is little incentive for the hawks on the ECB to say, you know what, we can just do with 150 basis point hike in February and we can go slower at March. I just don't think that's how the script is going to play out. I think the script is going to play out pretty much as President Lagarde said at last month's meeting, which is that we need back-to-back rate increases of 50 basis points. So my own thinking is that we are going to get 50 basis points on Wednesday, 50 basis points in March, and 2 more increases of 25 basis points each by June to get us to the 3.5% terminal rate by the end of the summer.
Ven, thanks very much. Bloomberg's Ven Ram from the Markets Live team with the latest on what to expect. It is a really busy week. The Fed, the ECB, also the Bank of England, of course. For more market analysis, check out MLIV Go. They'll be all across the Fed, of course, the big event of the week in the Markets Live blog. This is Bloomberg.
got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now, keeping you up to date with news from around the world, here's the first word. In Iran, authorities say that a drone attack caused a heavy explosion at a Defense Ministry ammunition depot. The attack happened in the city of Isfahan. According to the Wall Street Journal, Israel carried out the strike. The journal says the aim was to look for new ways to contain Tehran's nuclear and military ambitions. President Biden will meet with House Speaker Kevin McCarthy on Wednesday to discuss raising the debt ceiling and avoiding a U.S. default. Republicans want a deal that includes government spending cuts. The president has refused to negotiate over the debt limit. Turkey's President Recep Tayyip Erdogan may back Finland's bid to join NATO while rejecting Sweden. Erdogan told state-run TV that Sweden will be shocked when Turkey gives its response. Turkey has balked at ratifying Sweden's bid over its hesitance to crack down on supporters of Kurdish militants. And it will be the Kansas City Chiefs versus the Philadelphia Eagles in the Super Bowl. The Chiefs beat the Cincinnati Bengals 23-20 with a last-second field goal to win the AFC Championship. Meanwhile, the Eagles pounded San Francisco 31-7 in the NFC title game. The Super Bowl is set for February 12th in Glendale, Arizona. And Matt, I think I'm on Team Chiefs now because I was Team Bengals, but I'm definitely not Team Eagles.
Yeah, well, I'm also not for the birds, and I don't really care that much about pros versus college football, but they really have to institute Sky Judge because so many bad calls against Cincinnati makes it look like the league doesn't want the Bengals to win.
Okay, I'll be keeping it entirely neutral, and we'll get back to the markets conversation shortly. Ben Guthridge joins us, Invesco Asset Management Director of Model Portfolio Services, ahead of a big week for central banks and earnings. This is Bloomberg.
institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Stocks and futures fall as investors wait to see what the Fed, ECB and Bank of England do this week. An unexpected jump in Spanish inflation boosts ECB rate bets. The Adani sell-off gets worse. Companies controlled by Asia's richest person have now lost $72 billion in market value since a short seller accused the business of fraud. And Renault has agreed to lower its stake in Nissan. It's a move aimed at ending a source of friction between the two automakers as the industry prepares for historic change. I'm Anna Edwards in London with Matt Miller and Kaylee Lies in New York. And Matt, it's hard to overstate the importance of this week in terms of the central bank meetings that are taking place. Of course, the Fed central to all of that, plus the earnings stories, big tech names in focus later in the week.
Yeah, absolutely. We're going to get to the big earnings stories, but I think right now the market really is focused on the Fed narrative, and it's not just the ECB that is highlighted by Spanish inflation, the resurgence there. I guess resurgence is a strong word. Maybe the beat. I think it looks like U.S. investors realize that could happen here as well. And that's one of the reasons that S&P futures are down 0.9%. It's a pretty significant move to the downside. But also, it shows us just how high we finished in the cash trade on Friday. We were up at 4,070. And for a lot of strategists, that's already their year-end target. We haven't gotten to the end of the first month of the year yet. The U.S. 10-year yield right now rising more than 3.5 basis points as investors sell that debt. So 354.21 is the number, going out 5 significant digits. You also see NYMEX crude coming down under $80 a barrel. So West Texas Intermediate trading at 79.22, and a lot of red on the screen. Bitcoin is off. But I should note, this is from yesterday's close, or really from, I guess, midnight last night. Bitcoin hit almost $24,000 in price at the end of Sunday trading, and now it's down, but to a higher level than we saw on Friday at 23,273. Kaylee, what do you see in terms of pre-market movers?
Well, on the note of Bitcoin being lower, you are seeing that reading through to some of those crypto-related equities in pre-market trading like Coinbase, the big public exchange. It's down about 3.5%, but really there's just weakness across all varying parts of the technology sector this morning. That's really what's leading the losses for futures, including for Tesla, down about 0.9%. So giving back some of the really remarkable gains from last week. Remember, last week up 33%, the best weekly performance going back to 2013. Then we have, as you said, more earnings are coming later on this week, including more from the chip space. AMD will be reporting tomorrow. It's down about 1.6% to start the week. And some weakness for those big Chinese technology names as well. We saw that in Asia overnight. It is continuing with the ADRs here in the U.S. Alibaba, for example, down the better part of 6% before the bell, Anna.
Kaylee, here in Europe, then we see overall weakness for European stocks, down by 0.7% on today's session as we head towards the end of the month of January, of course. The technology sector is in focus here in Europe, considerably weaker than it was, but a lot of that has to do with Prosus, which has a big holding in Tencent over in China. And as a result of the weakness in the Hong Kong listing of that business, we see that Prosus is weaker in that ways. But many sectors in Europe are in negative territory, as you'd expect when we're down quite substantially. This is the euro, though, 109.10, so not down on the euro. The euro jumps. That's on the back of that Spanish inflation print. We had expected the inflation print to retreat from a 5 handle to a 4 handle in terms of that year-on-year move, but it didn't do that. In fact, we got a jump, a higher reading on Spanish inflation, and so that really puts the ECB in focus this week. We had already expected a 50 basis point move, so maybe the narrative moves to the following month. Will we get something similar? Philips is up by 7.4%, and this is a business that delivered some numbers that backward-looking really beat expectations, but also decided to announce some hefty job cuts. And we've seen with big tech over in the United States that those job cut stories, that focus on the cost base has gone down, at least in the short term, quite positively with investors. And this is Renault down by 1.7%. The car maker coming to another agreement when it comes to its alliance with Nissan and reducing its stake in Nissan, albeit slowly, putting some of it in a trust, and then they'll sell it when the commercial terms seem favorable. So that's what's happening there. But a lot of questions still, Kaylee, to be answered about the exact working relationship and an investment still to be made by Nissan into Renault. A lot of those questions still unanswered.
Yeah, and we'll be looking for those answers over the coming weeks, Anna. Meanwhile, we do have some breaking news to mention. Russia is planning to increase its diesel exports in February, despite Europe's ban on those exports. Russia is planning seaborne diesel exports at 2.74 million tons, so it'll be interesting to see who exactly the buyers are of those upped exports. And of course, all of this factoring into the energy conversation for Europe and the world more broadly, and the inflation narrative, something central banks have continued to weigh and will do so again when they make decisions this week. Joining us now to discuss further is Ben Guttridge, Invesco Asset Management Director of Model Portfolio Services. Ben, good to see you. Thank you so much for being with us. If we could just begin with the Fed on Wednesday. 25 basis points seems like it's baked in. How hawkish could a 25 basis point hike be?
Well, yeah, you're right. It does seem pretty baked in, so it's sort of the communications about policy thereafter. You know, I think the market or the investment community is sort of inclined to believe there'll only be sort of one more hike before there is sort of a pause, a moment of reflection to see how all those hikes that have come prior impact the economy. But if there is, you know, a higher for longer interest rate communication, or, you know, that there could be, you know, a third or 2 successive quarter point hikes, you know, markets probably wouldn't like that.
Yeah, markets might not. And I suppose, are you focused then, Ben, on the extent to which inflation has come down from its highs, or the extent to which inflation might linger at these still relatively elevated levels versus recent history? Because that might dictate how the Fed leans in its narrative.
Yeah, that's right. Yeah, I mean, I think to answer the question, we'd be more inclined to favour the fading inflation or the moderating inflationary pressures, which would allow the Federal Reserve to deliver this and then one more rate hike. And I think markets, in conjunction with, you know, moderating inflation, slightly less hawkish central banks and slightly better growth stories globally, that would allow equity markets to perform. But on that basis, if it is a higher for longer like interest rate story, inflationary surprises to the upside, you know, our positioning might be caught a little offside with that.
Right, and in that context, you do prefer US equities. Is that based on some of the things you just described there? I mean, US equities have been struggling to catch up, although I note that the NASDAQ's been doing quite a good job of catching up with European stocks year to date.
Yeah, it's been a good year for the NASDAQ, isn't it, after a terrible year last year. But, yeah, look, I think there is a bit of sort of portfolio and risk management in this. You know, I think we're broadly quite positive about equities. I think US has a little bit of catch-up after sort of Europe's strength. There's also sort of a duration bit in there. You know, if inflation pressures fade, perhaps longer bond yields could fall. That's sort of good for the longer-term earnings story of US companies. But look, I think there is some momentum here for Europe on the back of its own sort of fading energy challenges and, of course, China reopening. So in the short term, you know, there is symmetric risk there. But I think on balance over the medium term, we prefer US equities.
What industries do you like in the U.S., Ben, in terms of what we've seen happen so far year to date. As Anna mentioned, tech stocks have done a lot better. The defensive stocks have done really badly year to date. Consumer staples, utilities, healthcare, all down.
Yeah, I mean, I think we would, by favouring US equities, I think we'd have to put our hands up that the broadly defined tech universe is going to be something that we would be sort of implicitly supporting. You know, clearly in the short term, what they're doing with relation to cost management is an improving story, and the bond yield element that I've talked about could help. But to the flip side of that, I think, you know, sort of the barbell of technology, we look to the energy sector, you know, the oil markets, I don't think really reflecting what's happening in relation to the sort of Chinese reopening story. Like lots of parts of the markets have moved quite quickly on that, haven't they? But the oil price certainly hasn't, and we think that could support the energy sector.
Yeah, exactly where I was going to go, Ben. I think it's fascinating when you look at the breakdown of industry groups on the S&P 500, that tech's done well, that the defensive stocks have done poorly. Energy's right there in the middle of the group. And with the Chinese reopening, you've got to ask yourself, are we going to see a surge in demand for things like oil, iron ore, copper? What do you think about commodities?
Well, I think there is a greater probability of a surge in demand for energy, for oil. And we think the sort of reopening story is more of a sort of a domestic recovery, and is less inclined to see sort of a sucking in of imports all around the world. I think, you know, of course, there's many parts to it, but, you know, going to the cinema more, going to the restaurants more, traveling more, you know, I think this is more of an energy story, or an underappreciated energy recovery story than perhaps, you know, commodities and aggregate sort of metals at large. So we'd favour, as I said, favour the energy sector above sort of mining in that regard.
Is it possible that the oil market is just at this point pricing in a greater risk of global recession than other risk assets, Ben? And is that appropriate?
Yeah, I think that would have to explain it, that the energy markets are weaker on the back of this China story, is that the greater concern is the prospect of a US recession, of a downturn in the global economy. We're not expecting like a marked tick up in the global economic conditions and outcomes, but we see sort of an ameliorating story, perhaps better than those sort of negative expectations. You know, as I said, China reopening, Europe energy complex boosting real incomes in Europe, you know, US inflation fading, that's better for real incomes there. We think on that basis, perhaps the growth outcome isn't as bad as anticipated, coupled with the China reopening. You know, perhaps the oil price is a little bit underappreciated at the moment.
Okay, and Ben, thinking about other asset classes, investment grade debt. So we're in a bit of a sweet spot there, given the sort of risk and reward as we wait to see how the US economy plays out.
Well, I think on balance, we would be favouring corporate credit. I think the risks are still quite symmetric. You know, I have painted a relatively positive picture here, but, you know, there is, I could be wrong, there is precedence of that. And, you know, this hawkish, if we get that hawkish surprises from the central bank, inflation stickier than anticipated, and a more marked downturn, you know, it's unlikely corporate bonds are going to do particularly well. But on balance, if we think about a mild recession or a soft landing, if you're allowed to use those terms, then corporate credit looks pretty well placed, I think.
You're allowed to use those terms.
Okay. Yeah, I guess I'm not that important.
Anybody can use those terms. Ben, thank you very much. Ben Guthrie is joining us there from Invesco. Coming up on the programme, opening Pandora's box, how Hindenburg's report on Adani may be a wake-up call to global investors on India. Interesting timing of this whole conversation on India in relation to its role in the global economy. We'll discuss that next. This is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. Now, the billionaire Gautam Adani's attempt to restore confidence in his business empire is falling flat with investors. The sell-off of Adani Group firms has now erased about $72 billion in market value. Shuli Ren joins us, Bloomberg opinion columnist. She's in Hong Kong. Her latest column explores how Hindenburg's report is a wake-up call, she believes, to global investors on India and across emerging markets more broadly. Shuli, take us from the micro then to this sort of bigger picture story. What is it that you think is important about the way that this story is playing out for investors who are focused maybe not on Adani but on other Indian companies or indeed emerging markets more broadly?
So the Adani report is coming out at a very interesting time. Last year, we know what happened to China, COVID-0, all the developer crackdowns, the deepest recession since the Cultural Revolution. So global investors, they basically de-risked and sold off their Chinese stocks, and they were ready to go somewhere else. And India was a natural destination, right? Like, they also have a population of 1.4 billion with younger population and brighter prospects. And whatever you say about Prime Minister Narendra Modi, he did clean up India and he's pro-growth. But what happened was that the Indian stock market is notoriously expensive. It's trading at over 20 times earnings ratio. And the global investors didn't really ask many questions. They basically just bought in because they wanted to escape from China. And the Hindenburg report basically said, wait a minute, Indian companies are not as clean as you thought. I mean, they also have corporate governance issues, and all their allegations sound very, very familiar, eerily familiar to China's HNA or China Evergrande Group, right? So the question becomes, is India worth the equity premium that the investors have bought into?
Shuli, the rebuttal by the Adani Group to Hindenburg says that Hindenburg is really attacking India itself and almost, exploiting racist tropes. It's, I think, a great defense because it kind of takes your eye off the ball. But is it fair?
Well, the timing is very interesting. I mean, it was released just at the time when India was celebrating its Republic Day. So it's very easy to whip up that kind of nationalist sentiment, right? I think in a way, the way emerging markets work, in a way, it could be considered fairly fair because with emerging markets, we know corporate governance is not an issue. Adani is willing to play Modi's aggressive industrial policy, and he is trying to build India's roads, ports, airports, green hydrogen, what you call it. Of course, the corporate governance issue is kind of brushed aside, not unlike what happened to South Korea at the chaebols.
Okay, so there's interesting politics at play here, given how closely aligned Adani is with Modi. So what does that mean for the long-term potential success of Hindenburg's campaign?
I think it's Hindenburg is very well regarding the New York's finance circle. Its founder had to work with the analysts who uncovered Bernie Madoff's biggest Ponzi scheme in the world. But it's no guarantee if we look at what happened in emerging Asia that a prominent short seller in New York can repeat his success in Asia. I mean, what happened with HNA, with China Evergrande? They had been harassed in a way by short sellers for years without much catalyst, to be honest. And these companies only fail when there was a changing political wind. You know, HNA failed in 2017 because the Chinese government was coming after private companies that were doing a lot of overseas deals. Evergrande fell in 2021 because China was cracking down on real estate developers. So I think the question at this point, there are two questions. Number one is Modi government going to distance itself from Adani? Number two is this short seller report going to shut down Adani's refinancing channels?
Yes, and that's a very active question, isn't it, given what they're trying to do at the moment over at these Adani businesses. Is there anything that Adani themselves can do then to try and stop the rot in the share price? I mean, they've put out more than 400 pages of explanation trying to rebut what Hindenburg has been saying, but the market continues to sell the stocks.
Well, I think if you believe Hindenburg's allegations, I mean, all the outstanding loans of the flagship Adani Enterprises is owned by the Adani insiders, right? If they want to do share price management, they can very well do that. But I think one thing they could do is to, you know, perhaps just let the New York fund make some money and go away, unfortunately.
Shuli, thank you very much. Thanks for bringing us your opinion. Shuli Ren from Bloomberg Opinion with the latest on the Adani saga. Coming up on the program, it is a big week for central banks, as we've said a few times. We will run you through the key events that you need to be aware of. That's coming up next. This is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now let's take a look at what is coming up for the rest of the week. Tomorrow, that's Tuesday, UBS and UniCredit will kick off European bank earnings. Then on Wednesday, it's the big one, the Fed's rate decision. Officials are poised to slow the pace of rate hikes for a second straight meeting with just a 25 basis point move. Plus, ISM manufacturing and JOLTS data are also out on Wednesday. That's followed by rate decisions from both the ECB and BOE on Thursday, which is also a big day for tech earnings. Alphabet, Apple, Amazon, and Qualcomm all will be reporting. And then on Friday, it is the jobs report here in the U.S. Of course, Matt, the focus going to be on average hourly wage ratings, and Anna, as well as the non-farm payrolls print. Right now, the average economist estimate, 185,000.
Yeah, certainly a lot going on this week. The list of central bank events, the corporate earnings story, there's just plenty in the mix, isn't there? Now, the U.S. Treasury Secretary Janet Yellen says she's encouraged by recent U.S. data on inflation and jobs. We'll get more on that this week, but conceded the economy is at risk of recession amid high interest rates. She spoke exclusively to Bloomberg's Chris Condon in Johannesburg in South Africa.
I don't want to minimize the risk of recession. In the absence of further, shocks, it really comes down to the labor market. And I guess the path that I see to maintaining a strong labor market while bringing inflation down does involve a slowdown in growth.
Yeah, really interesting conversation there about the labour market. And of course, Matt, that is going to be front and centre once again this week as we work our way towards the Fed and then that non-farm payrolls number on Friday. To what extent is it going to be possible to bring down aggregate demand in the economy whilst at the same time not doing too much, but doing enough damage to the labour market to make it less tight, to weigh down on wage pressures? All of that very much a live conversation still into 2023.
Yeah, it does seem like there's still a lot of optimism for a soft landing, as Ben Guttridge just said, and as you allowed him. We can all use that terminology. But the question is, will we have a jobful recession? Will we have any recession at all? I think we need to continue being reminded that there are long and varied lags of Fed policy, because it just seems too hard to imagine that this could come back and bite us, especially when we get a printout on inflation like we saw in Spain. That could happen anywhere, and I think that's an important reminder as well.
Yeah, it's a question of if the Fed doesn't go far enough to get inflation down to target, could we see a resurgence of it if the economy stays too strong, if the labor market remains too tight? I think that is the concern. Chairman Powell doesn't want a repeat of 1980, right? That is kind of the legacy he's trying to fight against. So I'm really interested to see how hawkish realistically a 25 basis point hike on Wednesday could be. And if it's all about March and whether or not another hike or a pause comes in that month, the jobs report on Friday is going to be really crucial in the formulation of that expectation.
Yes. It seems that a lot of the focus actually is going to be not just on the short-term decisions around policy, and this applies to the ECB or the Fed or the Bank of England, but actually the second half of the year and how much bond markets and investors start to reprice their expectations for the second half of the year based on this week's events. We'll certainly get into those conversations as we go through this week. That is it for Early Edition. Surveillance is up ahead. They'll be speaking to the head of U.S. economics at Bank of America Securities. Plenty of other voices, of course, also weighing in. A busy week, as we've said, for central banks. They'll be talking about all of those and the earnings report still to come. This is Bloomberg.
that are capturing most of your time and attention?
Well, you know, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do, and any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine, and in the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, you know, and the ultimate output for a company is share price, you know, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
We think structurally returns more broadly are going to be lower.
We think that the global economy is in a relatively good shape, and we expect to see a soft landing in the US, but we also now expect to see a relatively soft landing in Europe.
The Fed is beginning to kind of adjust to the fact that the economy is weakened and that it views itself as being in restrictive territory.
I think the market is probably severely underpricing what the Fed may say. I think they are likely to be more hawkish.
The market is actually, in my view, underpricing the risk of hikes for this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a week coming up. Live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Lisa Abramowitz. I'm Jonathan Farrow. TK back with us tomorrow. Equity futures down about 0.8% on the S&P. The story of the year so far, though, an epic rally. The Nasdaq 100 up about 11%. The Euro Stoxx 50 up in Europe by 10%. Bramo, I guess the question for us this morning and most people on Wall Street, chase this rally or fade this rally going into the Fed on Wednesday?
And you started it correctly, which is that this week is a monster week, potentially a pivot point as we get not only word from the Federal Reserve on Wednesday, but also the ECB, the Bank of England on Thursday, and a slew of earnings that are really going to set up what the real read-through has been for the fourth quarter earnings season.
Fade this rally seems to be the tone coming out of JP Morgan and Mislav Matejka this morning. They say Q1 will, in our view, likely mark a turning point. Mike Wilson and Morgan Stanley, we're still trying to get used to this, on the same page as JP Morgan through 2023 so far, saying this morning, don't fight the Fed. Perhaps this week will serve as a reminder of that.
On the flip side, you've got the likes of Stephen Major of HSBC coming out and saying typically markets rally the most when you are near the penultimate rate hike, and that we look like we might be approaching that level. So really a two-sided story at a time of incredible uncertainty and complete upheaval of last year's main thesis.
Take your pick then. Central bank decisions, the earnings, or the payrolls report on Friday. If you had to pick one right now, what would it be?
Earnings. I think that earnings are going to be the key because nobody believes the Fed. That seems to be the takeaway. Don't fight the Fed. It's turned into fight the Fed. Everybody's going to fight the Fed. They're just wrong. I mean, honestly, that's what the message has been from the market.
Full coverage coming up on Wednesday of the Federal Reserve and that news conference right here on Bloomberg Surveillance. I'm told TK will be back, especially for that. Futures right now, negative 0.9% on the S&P. Check out the euro and the FX market. Earlier on this morning, Spanish CPI came in hot. German GDP came in soft. The ECB set to go another 50 basis points on Thursday, and euro-dollar reclaimed to 109 handle. 109.07 right now, positive 1/3 of 1%. Lisa, looking at yields higher by 4 basis points. Your 10-year in and around 350 for the last couple of weeks. Right now, 354.58.
And how much has that stability, that rally in the 10-year yield really underpinned some of the rally that we've seen in equities? Just to give you a sense of the week ahead, let's give you a real play-by-play. On the central banking front, we have the FOMC rate decision on Wednesday, Bank of England and ECB rate decisions on Thursday. You've been asking all week, last week, John, about who would go further, who would hike more this year. The ECB was the dominant consensus. How much does that get really ratified by what we see in this week's decisions? On the earnings front, we talked about what's more important. We have Thursday, we have Apple, Amazon, and Alphabet. Meta comes out on Wednesday. I am very curious about business spending. If you start to see business spending roll over, if you start to see the pain that we've seen in semiconductors push into some of these tech stocks, how much does it undermine the rally? Look at that rally. It has been absolutely tremendous this year so
Apple
far.
up 12%, Meta up 26%, Alphabet up 12%, Amazon up 21%. It's pretty impressive stuff, isn't it?
This is what's led. People were saying that tech wasn't going to lead. Then how do you explain this? And how much are you going to push back against that? And then on the data front, we get Wednesday JOLTS data, which I actually think is going to be really important. Thursday, non-farm productivity as well as jobless claims. And on Friday, the January non-farm payrolls report. How low do these numbers have to go before we can talk about true weakness in a labor market that's not seemed to be playing out in initial jobless claims and other peripheral metrics? And to me, that could potentially change the narrative in a way that you're talking about.
Do you remember the consensus coming into 23 as we wrap up the month of January in a couple of days' time? It was dip and rip, wasn't it? Wasn't the first half meant to be the bad half and the second half was meant to be the better half? Have we switched that in the last couple of days?
Okay, look, it's not the last couple of days. That ended about January 3rd, right? That was the rip and dip, though the dip and rip turned into the rip and dip by the second week of January. And now we just seem to be perhaps the rip and never dip because it's over.
Steve Chevron joins us now, the head of multi-asset solutions at Federated Hermes. Steve, wonderful to catch up with you. Bearish for so long, Steve. If I asked you this question this morning, do you chase this rally or fade this rally? How do you answer it?
Yeah, we got on the other side of it right at the beginning of the year. I think there are opportunities for this rally to go longer and higher than you would expect. I mean, you've got inflation that's likely to come down given the year-over-year comps. Earnings season expectations were so poor. The market was looking for this kind of first half recession, but the labor market's going to take a much longer time to kind of decelerate. So, you know, we think that this strength can go higher. You traditionally have 15, 20% rallies when you have Fed pauses. Those are usually suckers rallies, usually. And so I think it's premature to cancel the recession. I think there's so many signs that the economy is likely to head into recession, but it's going to take a while. And that's been the hallmark of this whole cycle. Every stage has taken longer and gone farther than you expect. We think this rally could last us through mid-year, but ultimately we still do have those concerns about recession. We just think that's a kind of second half story. And in the meantime, you've got to play this.
So Steve, talk to me about how you're playing. Is it through international? Is it through US tech? A combination of both?
It's exactly what we did. We didn't want to jump on the tech train at the beginning of the year. We think earnings there are still vulnerable. We think valuations are still very much too expensive. We get that they're going to run on this kind of rally, but we decided to do it internationally. We did it both in developed and EM international. But again, this is a rally that we're dating. It's not necessarily one that we're marrying, at least not yet.
So how do you know that the date's over and to break up?
You got to keep following the fundamentals. If it turns out that the market is moving higher and we're in the mid, 4,000s, let's say by mid-year, yet earnings are still coming down, yield curves are still inverted, the labor market is continuing to slow. People look at this and they're confounded by the labor market. Unemployment doesn't rise before a recession. It rises in one. And in fact, it takes usually 6 months to go from the low in unemployment, which we just hit, to the start of a recession, over which time the unemployment rate really barely rises, maybe by 0.2%. And so I think you have to look at those emerging layoff announcements, see if the labor market continues to weaken. And if it does, you're going to need to fade this.
When you go into
if it doesn't, it's a different story.
But when you go into emerging markets, Steve, how much is this really a story about China and the reopening there, and just entirely riding that until we get more concrete data on just the contours of what that looks like?
I mean, it's certainly a big part of it, but it's not the entirety of it. I'd say the other key factors here, you do have a Fed that's likely to pause. Emerging markets in general tend to do better when the Fed's not hiking. You've got a dollar that's weakening, and I think it may weaken, right? You were just talking about maybe the ECB is going to be a little bit more aggressive than the Fed this year in terms of rate hikes. You'd have to expect at some point Japan might have to abandon yield curve controls. And so you may have this scenario where a weaker dollar no more rate hikes, plus a China reopening gives you, a decent window here. The stocks are certainly reacting to that.
Steve, let's get to the Fed on Wednesday. If I was in that news conference and I was a journalist, this is the question I would ask. Do you believe we've seen an unwarranted easing of financial conditions? Very simple. Let's see how he answers it. How do you think he will approach that question? Because it's very likely to be asked.
I mean, I think they've got to be frustrated, John. I mean, if you look relative to a year ago, not necessarily the peaks mid-year, but one full year ago, the labor market's incrementally hotter than it was 12 months ago. Inflation is as hot, if not as hot as it was 12 months ago. Now it's coming down, so I don't want to discount that. But financial conditions are much looser, and they've spent so much political capital trying to defend this median dot. You would think that they're going to have to see it through. I don't think that you're going to have a recession or not because of an extra 25 basis points. So my guess is if they go to 25 here, they might do 2 more 25s to at least get to that median dot. And I would expect that he would push back against these financial conditions some. That being said, I have not had the best luck at predicting what Powell's going to say. I've had a much better job predicting what he's going to do. So we'll see. I'll be watching along with you, and we'll see how he responds. But he's going to get that question.
Steve, can you pair that idea with your bullishness right now, the riding of the rally? Why is it not going to be successful if the Fed does try to jawbone down this market?
Why? Well, because I think that the data is going to look encouraging, and the data on the road to a soft landing doesn't look very different than the data on the road to recession, right? Inflation is going to come down. Earnings are going to come down. You would expect that in a soft landing, but maybe not catastrophically. You expect the labor market to slow. And so you've had a market that for the better part of a year has wanted to rally on any sign of good news. I think they're going to get data that can be construed that way. Ultimately, I think that is on the road to recession. It would be a historical anomaly to have this much of the yield curve inverted. And I could go through all the various different statistics and not have a recession. But if you go back every cycle, the market has a big hurrah rally like that. It did it in 19. It did it in 2006. And so I think those are the powerful forces. The market's going to see what they want in this Rorschach test. And there's been a bullish lean for the last year. And usually the last one's the biggest one. And I think that's, at least what we're in. It can last 6 months. It could be 20%. And so, if you're a long-term investor, you might be able to ignore that. But if you're trying to manage, through the markets as our charge, I think you got to be cognizant of that risk right here.
Well, it's lasted 4 weeks so far this year in 23. Steve, great to catch up, buddy. As always, Steve Chevron there of Federated Hermes, getting you set up for the Federal Reserve this coming Wednesday. The Federal Reserve decision and news conference with Chair Powell. Even at this point, if you could guess what Chairman Powell was going to say, could you guess how the market would respond to it? Because over the last few months, Bramo, you just get the feeling the market participants, one by one, have turned on, deaf ears to what Fed participants, Fed officials are telling them about what they want to do with Fed funds.
Well, you just heard Steve right there. He's bullish. He thinks you should ride this rally, and he thinks that Fed officials are going to push back. The implication is perhaps that people are going to shrug off whatever they say. It's just jawboning. Again, the don't fight the Fed has turned into fight the Fed with everything you've got because they're wrong, and that suddenly seems to be the mantra across markets.
JP Morgan fighting this move. Mislav Bateka, here's the full quote for you. Confirmation for the next leg higher might not come. Instead, markets could encounter an air pocket of weaker earnings and activity as they move through Q2 and Q3. Are we pushing this out? Is that what we're doing here? Are we pushing the bearishness out?
Okay, the earnings haven't been great. So people are saying, yes, when the earnings start getting worse, they're not great. You see a lot of weakness, pockets of real trouble. So at what point are they bad enough at some sort of holistic level versus this rolling recession that we see during different industries? At what point does this start to get people's attention? Or is it really, as Steve was saying, people want to rally, so they're going to find a reason. They're going to find the silver linings in the Rorschach test.
What's your big question for Chairman Powell Wednesday?
My big question really is how much are they going to push back against market conditions? And can they do it in a material way by, say, raising rates by 50 basis points? I know Mohamed El-Erian was suggesting that last week in a column that, maybe they should shock the markets. And he's not alone in thinking that.
Should versus will.
Yeah,
maybe they should. Do you think they will?
Well, no, but I wonder what Lael Brainard, if she actually does leave the Fed, I wonder if that changes some of the feeling there.
It'll be an interesting conversation in the next couple of months. Coming up on this program, Ken Trop in there, the founder and chairman of Graham Capital. Looking forward to that conversation in about an hour from now. Equity futures, as we kick off the trading week, down hard actually by 8 or 9 tenths of 1% on the S&P. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo.
In Iran, authorities say that a drone attack caused a heavy explosion at a Defense Ministry ammunition depot. The attack happened in the city of Isfahan. According to the Wall Street Journal, Israel carried out that strike. The journal says the aim was to look for new ways to contain Tehran's nuclear and military ambitions. In the UK, Prime Minister Rishi Sunak will try to get back on track today with a plan to overhaul the struggling National Health Service. Sunak's blueprint includes more ambulances, more hospital beds, and longer hours for urgent care centers. Over the weekend, Sunak fired Conservative Party Chairman Nadhim Zahawi over his tax affairs following weeks of damaging headlines. The Federal Reserve set to shrink interest rate hikes again this week. Policymakers are likely to raise their benchmark federal funds rate by a 1/4 percentage point on Wednesday. That would follow recent data suggesting the Fed's aggressive campaign to slow inflation is working. The European Central Bank's first interest rate decision of 2023 is still just days away, but the focus has already shifted to what will happen after that. A half-point hike is all but guaranteed on Thursday. The question is whether policymakers plan to repeat that move in March or open the door to a smaller increase. And it will be the Kansas City Chiefs versus the Philadelphia Eagles in the Super Bowl. The Chiefs beat Cincinnati 23-20 with a last-second field goal to win the AFC Championship. Meanwhile, the Eagles, they pounded San Francisco 31-7 in the NFC title game. The Super Bowl set for February 12th in Glendale, Arizona. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
Pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
I know the president said he didn't want to have any discussions, but I think it's very important that our whole government is designed to find compromise. I want to find a reasonable and a responsible way that we can lift the debt ceiling but take control of this runaway spending. We haven't been in this place to debt since World War II, so we can't continue down this path.
Speaker of the House there, Kevin McCarthy, speaking on CBS over the weekend. Live from New York, good morning to you. Big week ahead. Let's give you a flavour, a snapshot of the price action this morning in equities. On the S&P 500, futures down 0.9%. Tough time for Chinese tech. We'll pick up on that story a little bit later after a phenomenal time for Chinese tech over the last 3 months. In the bond market, yields higher going into the Fed on Wednesday. Payrolls on Friday, 354.40 on a US 10-year. That's your yield. Crude not doing much. Euro dollar doing something. 109.07. That currency pair positive by a third of 1%. A little bit earlier this morning, Spanish CPI came in hot. German GDP came in soft. We're looking for the ECB to go 50 basis points at this meeting this week on Thursday, and maybe again at the meeting after that, and perhaps even again in the meeting after that. Some pushback this morning from Mislav Matejka of JP Morgan, Mike Wilson of Morgan Stanley, Max Kettner of HSBC, publishing just minutes ago. And Max had this to say: hawkish surprises could upset some of the bullish repricing. It won't take much to prompt a short-term setback for risk assets. He's talking about central bank decisions this week, particularly the Federal Reserve on Wednesday. But he said this to follow up: this won't change our first half view. In fact, we'd rather increase exposure to risk assets during such setbacks. Now, let me be clear about Max. We came into this year, the consensus view was first half tough, second half better. Max Kettner of HSBC flipped that quite early on in the year. Bramah, who looked for a better first half and maybe a tougher second half.
Which is what it seems like everybody did.
Well, price action will make you change your mind quickly, right?
Well, it's price action, but it's also the fact that the data shows a real deceleration in the inflation in the U.S. Perhaps we're past peak inflation. And that's the reason why people are not buying the fact that the Fed is going to go as far as they say. They keep pushing back. And that's the reason why perhaps jawboning can work for a week, but not longer than that.
Does the debt ceiling conversation change that? Isn't that the most frustrating conversation at the moment? Every time I bring it up with a guest, we do a segment, we set it up. The producers on the 9 o'clock do a great job of just coming up with the sound, all the quotes, all of that good stuff. Then I go to the guests, and the guests just go,
no,
just stop. I've got nothing to say. I've got nothing to say.
You know, and this is the issue, because especially with politicians knowing what a political liability it will be if they do somehow end up in a 2011 type of scenario, it's one reason why people push back against this. It will get taken care of. It just will be kind of messy. At the same time, you do wonder over the longer term whether there does, have some, longer term price action.
What's different this time?
It's exhausting. This is so exhausting.
You can say
Why do
it if
we
you
have to deal
want.
this?
Reasons to think it's different this time?
Well, it's reasons to think that maybe it has a longer lasting kind of, premium on debt that you have to pay out, and people look at the political instability, and, the problem is that it's like this everywhere in the world.
It is.
So how are you going to deal with this in a sort of vacuum if you also have strikes everywhere and complete internecine battles in every other democratic nation?
Anne-Marie joins us down in Washington, D.C., our Washington correspondent. AMH, let's start there. Any news on this? Any chance that we just kind of kick the can further down the road?
Well, it does seem like at least the talks right now look like they're in a slow motion, right? We finally have a date, though, Jonathan, when President Biden will be sitting down with Speaker McCarthy. Obviously, the debt ceiling, top of that agenda. Speaker McCarthy does say, and he said this weekend on Face the Nation, that he thinks he can come to a reasonable agreement with the president. But so far, with these battle lines that are drawn between the Republicans and the Democrats about raising the debt ceiling, and the Republicans wanting an extraction of federal spending for that, there's been no movement. One thing McCarthy did say over the weekend is that Social Security and Medicare should be off the table. Doesn't mean he has potentially the votes for that, but he said all discretional spending, including defense spending, on the table. So it'll be interesting to see what comes out of this meeting, and that's taking place on Wednesday.
Anne-Marie, just, I have to ask, do you think Kevin McCarthy regrets taking this job?
Well, I'm not sure about that. I think this is something he's wanted for a very long time. And the fact that he was able to last, 15 votes and still continued to want this job, I think knowing the individuals, the personalities he was getting on board with, he's prepared for it. But I do think he knows that he is walking a very tightrope, right, between the extremes almost of his conference.
So given the fact that he is walking a tightrope, what would be the purpose at this moment to visit Taiwan, to go over to the island that has caused so much controversy over in the South Asian Sea?
Well, he said in the past when Speaker Pelosi went last year that this is a trip he'd like to do if he was Speaker, preparing for, his leadership in that role. We don't know yet on any fixed dates. He has said he wanted to go. Punchbowl News is reporting that there are talks of a trip in place. This would be about the Republicans as the Democrats have had, making sure that they are standing up for Taiwan and also showing that they are not just talking tough, but almost walking the walk when it comes to making sure they are combating China and China's, what many perceive as growing threats. It's an interesting moment and time for it because obviously you have the Biden administration trying to warm some relations with China and get some conversations and dialogue back on track. And Secretary Blinken will be headed there as well in early February. So this will only draw the ear of China, which we've already seen from the Beijing Foreign Ministry this morning talking about this to reporters.
Anne-Marie, can we set up the conversation for the next hour? We'll have a longer conversation on this, but I just wanted to tee it up with you. The race for 2024, the former President Donald Trump over the weekend. This line jumped out to me. I'm more angry now, I'm more committed now than I ever was. There's been a lot of questions about his campaign or lack thereof. AMH, I thought we'd be hitting the ground running talking about the current president making another run at this, and we haven't had the official announcement there either. Now, Document Gate seems to have taken over completely in Washington. Where are we on the race for 24?
Well, so far we only have one candidate running, and as you mentioned, that's former President Trump. Two really important states he visited this weekend, South Carolina and New Hampshire. It does seem that his campaign has lost some of the momentum and heart, as Governor Sununu put it over the weekend, CNN, that you saw that fight he had in 2016. We are still waiting from an announcement from the current President Biden on whether or not he's going to run for 2024. But Jonathan, all the conversations direction does look like he will get in that race. But it's still very early on, especially on the Republican side. And if you look at all the polls, a lot of them been conducted over the past week or so, it does show that Governor DeSantis has a much better chance, an opportunity to win than if it was to be the former President Trump.
What did you make of the comments from Nikki Haley, the former U.S. ambassador to the United Nations, Anne-Marie? What did you make of that?
Well, she didn't show up in South Carolina, right? She was supposed to be there alongside the likes of Senator Graham to talk about these are his allies when it comes to this campaign. And she decided to not go because she said originally she would not get in the race if the former president was running, Trump. And it does look like she is now potentially going to throw her hat in the ring.
Time for a new generation. Ramo, how did you respond to that?
Adding, can I be that leader? Yes, I think I can be that leader. So a new generation, that's me. That's what I
said. Mike Pompeo recently as well. Absolutely shredded. Absolutely shredded. If that's a man that's preparing for a run, I think that's a man preparing for a run.
Are you looking for diet tips?
No, seriously,
for what kind
looking
of
absolutely fantastic.
Yeah, exactly.
Seriously.
So what do you think he lifts?
I've got no idea. I wouldn't possibly comment. If he wants to come on and talk about any of that stuff, we could talk about politics first and then get to that. But he looks brilliant. Nikki Haley seems to be throwing her name into the hat as well. This could be a really competitive race for that party.
Which raises this issue of what does the Democratic Party do on the other side? Because perhaps President Biden could win against the former President Trump. But what about some of these others if they were to win the nomination?
AMH, looking forward to this conversation in the next hour. Anne-Marie's going to drop by again. In just a moment, Bruce Kasman, chief economist over at JP Morgan, is going to join us too. It's not just payrolls this week, it's the ISM. And the PMIs, the S&P Global PMIs, sub 50 for how long? I think you've got to go all the way back to August.
Well, yeah. Are you more interested in the manufacturing or the services ISM?
Oh, I think if we can get both, great.
And
we do get
both.
That's
a good point. I know.
I
I'm
totally agree. Manufacturing is very clear.
Yeah.
Manufacturing is
Exactly.
weak, without a doubt. Does it spread to services?
That's what I want to say.
Do claims start to tick higher?
It'll be
Because data point of the week last week was claims.
We're going to get both the non-farm payrolls, and then we're going to get those ISM prints, and that's what I'm going to be really focused on, the services side of that.
What a busy week. Futures down 1%. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Going into the Federal Reserve later this week, equities down hard on the S&P after a massive run year to date over the last 4 weeks. On the S&P right now, we're negative 1 full percentage point on the S&P. On the Nasdaq, quite a run year to date. The Nasdaq 100 up 11% coming into Monday. Futures now down by 1.3%. Plenty of bearish talk from Mislav Matejka at JP Morgan. From Mike Wilson at Morgan Stanley this morning, don't fight the Fed. Perhaps this week will serve as a reminder. Going into the Fed decision, yields look like this. 2s, 10s and 30s. On a 2-year at the moment, 423.41, yields high by 3 or 4 basis points. On a 10-year, up by 4 basis points to 354.58. We heard from Lisa a little bit earlier this morning mentioning the latest letter from Steve Major, his newsletter over at HSBC, who said for bond investors to buy cheaply, they need to start doing so near the top of the rate cycle. On just about every penultimate rate hike in the US, it would have been a good decision to buy. The question is whether you think this hike coming this week is the penultimate rate hike, and we can talk about that with Mike McKee in just a moment. Want to finish on foreign exchange. Euro dollar shaping up as follows. Stronger euro today, weaker dollar. Euro dollar 109, just about 108.99. Earlier on this morning, Spanish CPI came in hot. We'll get CPI from France, Germany, Italy over the next couple of days, but CPI